Your research, week after week, has been so consistent around this idea that this Fed is still going higher than some people think. And as a team, you and the team, from my perspective at least, have really underplayed the potential for this banking crisis, if you can call it that, some people might push back, becoming a big deal for this economy. Andrew, every note I read, precisely the same from you, incredibly consistent. Why is that, Andrew? Why is that the position of you and the team, that you believe the banking stress of the last month or so is not going to be a major economic issue that leads this Fed to have to back away?
So when we try to forecast what the Fed will do, we think about growth, we think about inflation, and then we think about these financial stability issues. And the framework that we have in place, which has worked well, is to say, as long as growth and financial stability are okay, and this is important because it's not that there are no issues around growth, it's not that there are no concerns around growth, it's not that there are no concerns around financial stability. To your point, we just had the second largest bank failure in the history of the United States. But if that is sufficiently contained, if that is not going to slow the economy, say, 0.5 percentage point or more, and we don't think that it will, then you go back to inflation. And it is a Fed that has a mandate of price stability, also full employment, but we're at full employment. We're probably over full employment. So that price stability mandate means you have to get policy rates higher. And I would just point out to everyone this morning that policy rates are not especially high now. I think it's certainly the case that we've moved policy rates higher very quickly. But if you look at where core PCE inflation is coming in, we're going to see it for the first quarter, probably going to be right around 4.7%. Policy rates are right around 4.7%. So we've just gotten policy rates back to where they're equal to the level of inflation. Usually you would think you would need to go beyond the level of inflation. So I really do think that the data are going to have the Fed hiking further. Are these comfortable hikes? No, absolutely not. It's certainly uncomfortable for the reasons that you lay out. Do we know that there won't be further financial stability issues? In fact, there probably will be. It's just that if they're contained enough, if they're not of the nature that slow down the economy enough to slow down inflation, then the Fed has to keep moving.
What are you seeing, Andrew, that fights against this this assertion that Steve Englander put out there, that core CPI taking out shelter is already back to the 2000 to 2019 range? We've already gotten back to close to a more comfortable rate for the Fed.
Yeah, so I mean, I'll get into some technical details. Steve is my former colleague, so I know he'll appreciate this. But what I would say is look at the non-shelter services. That in PCE inflation, which is the Fed's preferred inflation guide over and above CPI, you still see those services running strong. We know that we have strong wage growth. You've seen average hourly earnings that have slowed down a bit. And I think if average hourly earnings is telling us the right story around wages, that would be a reason to be hopeful. We're going to get the employment cost index tomorrow. I cannot highlight how important the employment cost index is. This is the gold standard labor cost measure. We saw in the Atlanta Fed wage tracker that wages look a lot stronger than they do in average hourly earnings. If you have this wage pressure, and if you have pricing power, which at least I know you've been talking about, if these firms are telling us they still have pricing power, those higher wages get passed into higher prices, and you still have an issue with inflation.
How does financial stability play into this? Because that has been the narrative that has been sort of the red herring for everybody who wants to agree with you, but can't.
Yeah, and I do think that that's an issue for the market, because at the end of the day, we can't know for certain, and of course we can never know anything for certain in markets. What we have to do is say, what is the most likely outcome? So we were early to say that the most likely outcome around this banking stress, and I would use the term stress, not crisis, is that it did not become something that is systemic. And I think that that's still where we are. We've talked a lot about this issue being on the liability side of the bank balance sheet, not on the asset side of the bank balance sheet. Now, are there risks that it could move on to the asset side? That, of course, is a risk. Is there a risk that you could get a broader contagion? Yes, of course. And these liquidity facilities, other regulatory tools are in place to try to prevent that from happening. The base case, I think, is that this is not systemic, and I think that's what we've seen so far. Can we rule out some probability that this becomes a bigger financial stability issue? You can't rule out that probability, but what we have to do is take a look at the market, see what's priced relative to what's priced. What do we think? And I think relative to what's priced, we're more optimistic on the outlook for the U.S. economy.
Andrew, why do we hate that word crisis so much? Why do people why are they so reluctant to use it when financial institutions this large have gone under?
Yeah, great question, John. I mean, I think we're really trying to distinguish here between systemic and idiosyncratic. And if it's a large enough financial institution, of course, there will be some knock-on effects for the broader economy. So it's not that there's not any macro story here, but because we used the term crisis for 2008, crisis now has a special meaning. This is kind of like depression.
Bingo.
And this is not 2008.
Andrew, thank you, sir. Andrew Hollenhorst, the City. Every single thing that happens in markets gets benchmarked to the extreme, which is 2008. And there is this reluctance to use words like crisis because it evokes 2008. Brown, does that frustrate you in any way?
We've diluted the meaning of crisis. If you've got bank failures and you have a real tightening in lending standards, is there a risk that we're not considering that enough, right? I mean, this goes to the Bob Michael conversation that you had yesterday, where you said this is really going to contract credit, and this is a flood of deposits that are leaving the system that will have material impact. People aren't able to recognize that because it can't be put under the word crisis.
Andrew Hollenhorst was at UCLA, and they have a legendary course at UCLA called Growth Theory 164. It's taught by Gary Hansen right now. And the bottom line is we have forgotten Schumpeterian creative destruction within finance. Chris Whalen is expert at this. And the basic idea is after '07, there's this new idiocy that we can't clear markets, so we just fester. Zombie companies? Are there zombie banks? Are there zombie finance? That's the heart of the matter.
And Tom, the Austrian school has been buried, as you know.
Yeah.
Just totally buried since the financial crisis, and just the very idea that almost every single financial institution is almost viewed as systemically important now, Tom.
Yeah, I think the major issue there is if we're going to do Austrian economics, we got to go remote from Vienna. I mean, do the OPEC
Any
meeting
excuse,
and,
right? Any excuse.
Get Bombarek and, the ghost of Schumpeter to help us out.
The central banker there's got things to say about the ECB.
They do they? Oh, big time.
Maybe another 50 basis points after that. Michael Nathanson of MoffettNathanson on Meta next. That stock in the pre-market flying.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. After making a few adjustments to his debt limit bill, Speaker Kevin McCarthy's plan has passed the House. The vote now puts pressure on President Joe Biden to begin talks with Republicans over the debt limit to avoid a possible payment default this summer. The president has said that it has no chance of becoming law. A federal appeals court has rejected Donald Trump's latest attempt to stop former Vice President Mike Pence from testifying before a grand jury. The panel is investigating whether crimes were committed by the former president and his allies as they try to undo Joe Biden's 2020 election win. Pence has said he won't appeal the order for him to testify. China is encouraging companies to boost hiring. That's underscoring worries over the labor market and soaring unemployment among young people. China will provide subsidies to employers that hire graduates and young people who are struggling to find work. Traders at Barclays did better than expected in the first quarter with a surprise increase in fixed income revenue. That helped offset a drop in deal-making fees at the British Bank. In an interview with Bloomberg, Barclays CEO was asked whether the UK was liable to the sort of chaos some US banks just went through.
The UK has been more insulated from that deposit flight across banks than certainly the US has been between the regionals and the big money center banks. Having said that, our deposit franchise grew by about £10 billion during the quarter. And a lot of that was actually corporates putting deposits with us.
Meanwhile, Barclays says costs in the UK rose 9% due to inflation. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
In Big Ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
In a way, Facebook's back to the meta Facebook that we used to know, which just grew incessantly and reliably for a long time. Big picture is advertising is stronger than expected, not only for them, but possibly, I mean, this could be a macroeconomic signal a little bit, because this is such a fundamentally global company that if their ads are doing better than anybody, even them, expected, that is encouraging.
That's the bull case for the broader economy and for markets too. David Kirkpatrick there of Techonomy, the founder, on the latest numbers from Meta. They've called it the year of efficiency. It might be the year of growth. A rebound for the ad business, unexpected for so many people. So what have we got on the table right now? A rebound in the ad business at Meta, cloud business at Microsoft looking okay. The broader story for some of the consumer companies, Kimberly-Clark, Procter & Gamble, Pepsi, Coke, take your pick. Double-digit price increases without much consumer pushback, Tom. That paints a picture of a pretty decent economy. Then you put that up against the leading indicators in the economy right now, and then you've got the doom and gloom on that side, and that's the debate right now, the push and pull at the moment.
And the push and pull's about profitability. I'm thrilled that Amy decided to put Kirkpatrick up there. The day Facebook went public, I had Kirkpatrick and Paul Kudrowski on set with me. And David made one of the greatest calls I've ever heard in the history of securities analysts, and he's not really a securities analyst. Let's make clear. He's iconic in writing the Facebook effect, the Zuckerberg effect, if you will. And we forget, this is like the Apple fee, Apple services part of Apple. Their EBITDA margin is modeled at 48 cents on the dollar. The profit machine they can be if they keep it going. You know, Lisa's kids are glued to Instagram. I mean, let's be honest. And Facebook and the rest, they keep it going. It truly is that cliche, minting money.
Number 2 stock on the S&P 500 this year, Meta, up 74% before this morning's move. By the end of today, it could be the number 1 stock on the S&P 500. The stock this morning is higher by something like 11%. TK, it's a big move.
Yeah, let's talk to a security analyst about this, John, and this big move. Michael Nathanson joins us. Now, different than David Kirkpatrick, maybe not the author of the Facebook effect, but he's looked at the new Zuckerberg effect as well. You nailed it in your note, Michael, and what I see here in terms of the maturity of this generation is Mr. Zuckerberg wants to be a serious technology company. Is this a systemic Silicon Valley shift?
I think it is. Tom, it's interesting that I asked him last year if his moat was his social graph that he had built. He's like, no, our moat is that we are a serious technology company that moves fast and changes things, right? And John and I over the years talked about Meta, and the stock was in the dumps. And they had to pivot away from a couple of things that were hurting them. And in very quick order they did. It's because they are a technology company. And then Mark became much more aggressive and ruthless on cost control. And that was a big aha, because people thought he was just not going to cut costs. And he's taken about $11 to $12 billion out of the cost base in 6 months. And that's extraordinary, right? So the combination of accelerating revenue and then cost cuts, the story, I mean, stock's going to keep going. I think it's $300 stock.
Yeah,
really
but
do.
Michael, I want to look at this on a broader basis. Moffett-Nathanson is iconic on this. We had your colleague in crime, Rich Greenfield, on the other day. You guys have followed these children from out of their dorms to the modern era. Is right now when these guys grow up, as it appears Zuckerberg has grown up?
Oh, without a doubt. I think having a founder who his entire life work is tied up in this, that's the payoff you're getting, right? He was not going to let this company die, and he took aggressive steps. And that's, you're right, Tom. Like, this is the evolution of his leadership. It's a great point.
We forget, Lisa, he's 38 years old. We forget that. You know, we're talking like he's 50 or 60. He's 38 years old. He's a kid.
We've known this,
Right.
and now he's proving himself in the actual bread and butter earnings. Michael, you increased your price target to $295 from $275. Where is that extra profit going to come from based on the earnings we just saw?
Lisa, it was a revenue story, right? So if you look at their guide for the next quarter on revenue growth, it was between 2% and 10% on the upside. We're at 5%, so we're smack in the middle of that. So we took our revenue numbers up to 8% next quarter. And if you look at the rest of the year, you have probably double-digit revenue growth by the end of the year. So that's what drove our, I mean, we were always above the street in terms of our price target, but now we're close to $300 because the revenue story is now starting to kick in.
Is there a dirty secret that's been exposed by the earnings of some of these tech giants that have been cutting staff, that they didn't need as big of a footprint? They don't need as many bodies, and so their expenses are that much lower?
Yeah, that's a great point. That's a dirty secret. You know, back when we covered media, if there was a great ad cycle at CBS, they didn't hire more people. But if you look at what happened in 20 and 21 and 22, as revenues were ramping, they hired more people, and there was not a benefit to that, right? The ad revenue came through. So now these companies are going back to pre-pandemic staffing levels, and the revenue base is coming back. So, I mean, we sound crazy, but we cannot be more bullish on Meta and Alphabet as well, just because of what you said. And they all learned a lesson, which is they overstaffed, and they can cut without really hitting the top line.
Michael, given the fact that you did increase your earnings, how much does that include the potential banning or sale of TikTok and the read-through implications for Meta, for Snap?
No banning of TikTok in our thought process. You know, TikTok's about $10 billion U.S. revenue base. It would flow to Meta, a little bit Snap. It's not our numbers. That'd be a home run, obviously. But you know, we've not contemplated that because it just seems so far removed. But what they've done, though, you know, with Reels is that they quickly adopted the best part of TikTok, right? So they saw a weakness in their business model, short form video, and they quickly engineered a solution, and now they're starting to monetize that solution. So, you know, TikTok exists today, and I believe they're taking share from TikTok given what they've just accomplished.
This is just an amazing story. This was an $88 name in early November.
Yes.
88,
Yes.
and you've got Michael Nathanson talking about 300, a $300 stock. Go on, Mike.
But Jonathan, we stuck by this thing, and some people did because
I know
the
you
reality
did.
was the revenues were self-destroyed. They had basically they were hit by Apple. Remember, Apple changed their IDFA signifiers on their mobile system, and then these guys had introduced Reels, which was not monetizing, right? But what killed the stock was this belief that Zuckerberg was an empire builder and wouldn't cut costs.
Yep.
Go back to that October conference call. Some folks jumped off of it because, like, look, this guy doesn't understand what's happening. But that's, to me, it was all about self-created revenue crisis that they've now engineered themselves past, right? What was so interesting is that this was not cyclical. It was in a way because 2021 was so good. They had a hard time lapping 2021. And then IDFA hit from Apple, and then Reels occurred. So it was like just all these waves were hitting the stock.
So, Michael, I've got to squeeze this in because I've only got about 45 seconds left. I apologize. There will be some people who don't hold this name, who look at this as some kind of cyclical signal. You just said that maybe last year wasn't cyclical to some extent. Is the success this morning cyclical? Is that a broader signal about the cycle?
No, because Alphabet's a bigger company that's in search and YouTube, and their results were okay, but they're not like this. This is a separate cycle tied to Meta and what they were trying to do last year.
Michael, just perfect. And great call, buddy, for sticking by this name at a difficult time. Michael Nathanson of SVB, MoffettNathanson, 88 in early November. 88. And to his point, there was this feeling that Zuckerberg just lost it. Didn't understand the importance of cost discipline, had changed the name of the company, he was chasing the metaverse, took his eye off the ball. Then we just got a monster turnaround.
And what we're seeing right now is that it's coming to fruition even without TikTok, even without artificial intelligence. It's this question of 3 billion people using its platforms every day on average. That is a game changer and a revenue producer at a time, regardless of the cycle.
Andy Jassy's not 38 years old, but the new leader, ex-Bezos of Amazon, is 55. And you wonder if after the tycoon Bezos exit, that you're going to get the same cost shock this afternoon with Amazon that you got with Facebook. To me, this is something a lot. I think of Michael Wolff, the entrepreneur in technology. People have been waiting for this, John, for 15 years.
Sure.
I mean, plain and simple.
Stock's flying up more than 11%. Can I just say that there's a lot of 38-year-olds this morning feeling young. Tom called them as kids. Kids.
Is something that you want to say?
Kids. He's a kid.
Well, that I guess is the story. I also think the fact that they figured out they didn't need as many kids in their employment.
It's true, I know.
Is kind of also a game changer.
Yeah, well, we're looking at that too. I mean, within the Bloomberg surveillance team. I mean, we got people standing around. I mean, we got you over there, they're standing around.
Are we a growth company?
Interns,
Is surveillance a growth equity?
We're
going from 88 to 300.
We're going to right size. We're going to left size.
What?
We're going to left size.
Viewers, Lisa. Viewers.
There we go. Right size
TK's
again.
been trying to get it into double figures for ages. Equities positive 0.5% from New York. This is Bloomberg.
DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
Quite frankly, I love this model right now.
The bigger question is, what does this do in terms of financial conditions more broadly?
Basically, every traditional leading indicator of recessions is flashing red.
I think we are on a slow bleed into the recession.
The odds firmly favor the U.S. economy being in recession in the third quarter of this year.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
More than 40% of the S&P 500 reporting this week. It's another busy morning for earnings. Live from New York City. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market positive by 0.5%. The numbers from Meta, better than good. The stock is absolutely flying at more than 70% year to date. This morning, Tom, the stock is up again by something like 10 to 11%.
We can look at tech as we want. I'm going to look at the tech company Caterpillar, and I'm sorry, this is not just tech, John. Well-executed companies are delivering division by division surprises in revenue, and this is what I talked about. Companies adapt with tech leading the way.
Adjusted EPS cap. 491. The estimate, Lisa, 382. The stock up by 1.6%.
How much is this because of good management? How much is this also because there is a reinvestment in farmland? There's a reinvestment in a lot of the physical plants that people build with the tools that Caterpillar makes. So there is this sort of question of the rolling recession and places of strength versus the places of weakness. You put it together, it is a muddle. We've been talking about this tug of war between the winners and the losers. The fact that tech, though, can remain the winner leading markets really gives you a sense of how wrong people have been.
Some of those names absolutely flying. It's on to Amazon a little bit later after the close and onto the data at 8:30 Eastern time. Do you want to look back at the first quarter? I'll give you a GDP print. Do you want to look forward? Look at claims, Bramo. 248 in the survey. We've just started to see recently claims just tick a little bit higher. That's got people's attention.
Which is the reason why I'm watching that even a little bit more than first quarter GDP, which is a little more backward looking. This is more the forward looking. How much is the labor market weakening? That tick up is moderate. It is nothing screaming that there is some serious problem, but it is indicating that perhaps we're not seeing the strength with 2 open jobs for every unemployed American that we've seen for the past couple of years.
Your equity market more broadly positive, 0.6% on the S&P 500. Lots more earnings, lots more data. Lisa's going to give you the day ahead in just a moment. Your 10-year yield higher by a single basis point, 346.17. And in the FX market, the euro showing just a touch of strength against the dollar. Euro-dollar, Lisa, 110.50.
All right, so at 8:30 we get that number, the initial jobless claims number. We also get Q1 GDP. Do we see unexpected strength or weakness that possibly fuels some of the bears out there who are calling for a recession? Maybe we're even in one right now, as some people would say. Although these earnings, hard to really confirm that. Aftermarket, the tech giants continue. Amazon as well as Snap will be reporting. Very curious to see whether Snap sees the same kind of improvement in ad revenues that we saw in Meta, in Facebook, or whether this really was a consolidation of power, gaining in market share by the Facebook parent. Also with Amazon, how much do you see the pricing that we've already had in the market of 25% gains continue with resilience from people actually buying things? I think Amazon might be more interesting just simply because of UPS and that the packages were lower, and they expect that to continue. And at 4:30 p.m., this is what I enjoy doing with my time. I look at the Fed's balance sheet. I see how much it's coming down. I also look at discount window lending from the Fed. How much are banks still tapping this? What is the weakness on that other story of that tug and war that we see in markets?
That number stabilized but stayed elevated.
Correct.
I think it's the latter point that's still got people's attention.
And the mix of loans, how much people are turning to longer-term emergency funding and not necessarily just the discount window. Either way, people are parsing through this to understand how widespread this is. Is it just First Republic, or does it go beyond?
Lisa went through the tech names. Amazon up 25% year to date. Microsoft up 23% year to date. Meta by the end of today, could be up something like 80, 90% year to date. Emily Rowland joined us now, co-chief investment strategist at John Hancock Investment Management. Emily, wonderful to catch up with you. Are we learning, based on these earnings and stock price performance, that tech is defensive?
Yeah, John, it certainly seems like these tech companies are doing the Gronk spike right now as it comes to a Q1 earnings results. And, you know, we have expected for quite some time that there would be a bid for quality growth, which is largely found in the U.S. tech sector. And you think about these companies, they've got lots of cash on their balance sheets. They've got really good free cash flow, and they've broadly recognized that revenue growth is going to be harder to come by as we head into this decelerating growth environment. So they've managed costs, they've dealt with that through layoffs, they've defended their margins, and we're seeing that come through here in earnings season. So we are not surprised to see tech here emerge as leadership.
Where's the fear of missing out on this? I mean, is everybody on board big tech institutionally, or is it underowned?
I think it's underowned, and in fact, there's been a lot of guests on your show that have talked about tech being overvalued. You know, you look at the forward PE ratio of over, you know, getting closer to 30 times forward earnings, depending on the measures that you look at. But the reason that we see that tech is still reasonable is you've got to look at the entire equation. Earnings estimates for 2023 for the U.S. technology sector are negative 1%. So if you do the math, you have those more kind of reachable earnings estimates versus some more cyclical sectors like consumer discretionary, where you see 30% earnings growth expected this year. We think that those valuations actually make sense in that context, and we think tech is probably underloved.
So then do you diversify, or do you go ever narrower? I mean, Sequoia invented this a million years ago, owning X number of stocks, but is a major risk here, Emily, with the tech joy that we're all feeling? Frankly, Caterpillar is the new tech stock. Do we have too many stocks? Should we be in fewer sectors and in fewer individual securities?
I do think that there is a danger that tech can't continue to do the heavy lifting for the entire market here. So, you know, we want to diversify away from that. We have had some exposure to more cyclical parts of the market. Mid-cap value has been a favorite of ours. We've looked to that as a way to really play the onshoring theme, the manufacturing renaissance that we're seeing here in the U.S. And frankly, we funded the allocation of more cyclical parts of the U.S. equity market with an underweight to emerging market equities. So we're thinking about it from a holistic portfolio standpoint. We still see the U.S. as the brightest spot across the globe. We do have an overweight there. We've struggled a little bit with that one as of late, as we've seen this just face-ripping rally across emerging market equities in particular, as well as Europe. But we continue to believe that the U.S. is the best place to get quality.
Emily, why not the flip side of what Tom was saying, the idea of focusing on specific stocks? If you do have this sort of push-pull where sometimes the big stocks carry along the others, why not just go back to the indexes? This was supposed to be the stock-picking moment, and yet is it? I mean, if you have the sort of support of tech giants?
Yeah, I mean, I do think this is a moment where active managers can shine, and you've seen this concentration in the indexes as being, I think, an opportunity for stock pickers to differentiate themselves here. So we do, again, we want to be diversified. We want to own those big tech names, but we're also looking at mid-cap value down in market cap as a way to benefit from that. We're looking at the healthcare sector as another favorite in this market. Again, kind of, we want to be patient here. We want to kind of really think about, you know, owning, you know, different parts of the equity market, owning bonds. We still think that fixed income can do more heavy lifting in portfolios here. We are in this late cycle environment that feels almost never ending. As the lagged impact of Fed tightening is yet to really impact the employment market. So we want to be careful. We're treading water. We want to participate. It's getting a little tiring treading water here and trying to participate in this market that is very resilient. But be patient here as these late cycle dynamics play out.
Emily, you mentioned that it's been a very difficult trade to be overweight the U.S. and that you've hung on. Why have you hung on based on the fact that so many people see the U.S. as weakening faster than, say, Europe?
Yeah, so we use cycle analysis as the key input into making our decisions. And I mentioned I do see us in a late cycle environment, likely seeing a recession unfold. in the back half of this year. And we've never had an environment in which the U.S. has had a recession and the rest of the world hasn't. And right now, markets are telling you the opposite. You know, you wake up every morning, the euro's up, European equities are outperforming. The dollar weakening has certainly played a big role in that. But it's unusual to see this level of desynchronized global growth. Eventually, we see growth synchronizing again. We do see a global recession playing out. And one other really notable dynamic that we're watching is the fact that while European equities are on fire, emerging market equities actually haven't really kept pace. In fact, since the beginning of the fourth quarter last year, European equities are outperforming emerging markets by 15%. That is a magnitude that we've only witnessed about 5% of the time going back to the 1990s. So really unusual to see the leadership actually coming out of Europe versus EM. So we think that that dynamic changes, that gap closes, and eventually, again, you see markets acting in unison globally.
Euro Stoxx 50 up 18% year to date. It's been phenomenal. Emily, thank you. Emily Rowland of John Hancock. We talked about the French equity market, the CAC 40 up close to 20% as well.
CAC 40 is our
year to date.
CAC 40 report.
Luxury players, Tom. We've learned that tech and America defensive, based on the performance so far, not a judgment about the future. Luxury in Europe. LVMH absolutely flying.
They're
year
all
to date.
flying, and there's beginning to percolate. Okay, China reopening, has all the easy money been made? I don't have any opinion on this at all. But the basic idea is, you know, what's gonna go on here with LVMH, Hermes, and the rest of them. I happened to be in a store yesterday, just wandering by, and it shows the fragility of a given business plan. The store was called Gucci, and they are in designer turmoil. They have a new guy coming in who I'm told by them radically different than the last guy.
Will you be heading over to the flagship Tiffany store a little bit later?
I believe Mrs. Keene is working on this. It's not today, maybe tomorrow, but you know, it's very exciting for those of you worldwide. You know, you're in Tokyo and there's Tiffany behind the Imperial Hotel, and it is something about 57th Street and Fifth Avenue, and it's all brand new and all different.
Hundreds of millions they've spent on that,
LVMH,
reportedly.
yeah. No,
Hundreds of millions.
I have no idea how they're going to recoup that capital cost.
Well, I think they have recouped it already. If you think about what happened with the original price, they secured that deal at the end for, I think, about $16 billion.
Yeah, they went back and redid. They did a
$400 million discount.
Yes. Do they own all four corners? Do they all? I don't think they own all four. Maybe they own 3 of the 4 corners now.
I've got no idea.
Louis Vuitton's across the street.
True.
Van Cleef, I think, is over by Bergdorf, and I can't remember who's on the southwest corner.
Basically own Fifth Avenue now.
Yeah, well,
Arnaud's.
There they are. And
which Arnaud do you think wins this?
Don't know. Do not have an opinion on that.
No view?
No knowledge of that.
We'll ask Andrew Sliven of Morgan Stanley.
Yeah.
He joins us in the next hour with absolutely nothing to say about LVMH, so we won't talk about it. We'll talk about tech crushing it. Microsoft earlier this week, Meta yesterday, Facebook in the pre-market up 11%. Your equity market positive. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. House Speaker Kevin McCarthy's debt limit bill has squeaked through, escalating a standoff with President Biden. McCarthy overcame dissent from fellow Republicans to pass his first big test. It'll put pressure on the president to open talks with the GOP to avoid a payment default this summer. But the president signaled he won't give in to Republican demands. Bloomberg's learned that Germany is in talks to limit the export of chemicals to China that are used to manufacture semiconductors. Berlin wants to reduce its economic exposure to Beijing. Chancellor Olaf Scholz is trying to balance Germany's interest in China with national security and human rights concerns. Traders at Barclays did better than expected in the first quarter, with a surprise increase in fixed income revenue, and that helped offset a drop in deal-making fees at the British Bank. In an interview with Bloomberg, Barclays CEO was asked whether the UK was liable to the sort of chaos some U.S. banks just went through.
The UK has been more insulated from that deposit flight across banks than certainly the US has been between the regionals and the big money center banks. Having said that, our deposit franchise grew by about £10 billion during the quarter. And a lot of that was actually corporates putting deposits with us.
Meanwhile, Barclays says costs in the UK rose 9% due to inflation. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Bank of Japan holds its first monetary policy meeting under new leadership. Will they put the brakes on the recent stimulus boom, or is it full steam ahead with the BOJ's yield curve control? Bloomberg TV has full coverage of the meeting and analysis of what it means for the market.
Our BOJ team in Tokyo has learned the latest findings of what we can expect.
Policy normalization has to start at some point.
I would like to do my best to reach the target within 5 years.
It all happens today on Bloomberg. Live from the Milken Conference in Los Angeles. Bloomberg's all-star team will bring you the latest news and speak to the biggest names with the capital, power, and influence to change the world.
Globalization, certainly there's areas it's retreating. It isn't dead, it's just changing.
Technological change is real, it's fundamental. But that doesn't mean the purchase price doesn't matter.
Live coverage begins Monday at 10 a.m. Eastern Time on Bloomberg Television and Radio.
They haven't figured out the debt limit yet. Happy to meet with McCarthy, but not on whether or not the debt limit gets extended. Ron, that's not negotiable.
Now he should sit down and negotiate. We passed this early. We are in a way ahead of the debt limit. We just passed the bill. It's not our job to modify it. The Senate can pass our bill or send us something that they have, and we'll go to conference. Otherwise, we've done our job.
Speaker McCarthy getting it done. A lot of people didn't think he would. In the House, coming to an agreement with Republicans. President Biden, let's see how he responds to that later on today. No sign that they're willing to come to the table and negotiate just yet. We are getting a better idea, though, of when the so-called X date might fall. This from Goldman on tax receipts. They're pushing back their debt limit deadline from their prior June prediction. Goldman economist Alec Phillips saying this. Here's the quote. If the remaining receipts stay on this trend, the Treasury should be able to continue to make all scheduled payments until the end of July without an increase in the debt limit. TK.
A little bit of move out. Of course, tax receipts coming in as well. I believe the Abramowitz household helping with that. I think, it was a lift.
I think if
tax receipts were down and boom, I looked and said, really?
That's often the case.
Yeah. Really? And so there we go. And it's the dynamics we're all facing here into the summer and an uncertain fall as well. Amory Horton joins us now, our Bloomberg debt limit correspondent. Amory, forget about all the blather like the House is going to be defeated in the Senate. I get all that. Where are we going to be on Labor Day?
That's a great question. I think at this point we don't really know, except for the fact that with Speaker McCarthy's victory yesterday, which many were guessing he wasn't going to be able to get through due to the fact that he had 15 rounds to become speaker. This was one vote, and he was able to coalesce the ultra-right on his party and the moderate Republicans to get this bill past the finish line. And really, this
now points to potentially at least a conversation of President Biden and Speaker McCarthy to discuss what they're going to do about the debt ceiling. I'll also note, I think there's a bit of nuance into what President Biden said yesterday. I know these remarks in the Rose Garden, he was focused on his relationship, the U.S. relationship with South Korea, but he didn't say, Republicans, show me your budget. He just said, I need to make sure we're not going to default. Potentially a little bit of sunlight as to whether these two men are able to actually strike an agreement.
Yeah, Emery, I can make a joke about the Bloomberg surveillance tax bill and our contribution, but are we overtaxed? I mean, just on a basic idea in Washington, are we paying a lot of tax historically?
I'm not sure if you're overtaxed, Tom. I haven't seen your W-2 form, but what we're seeing with this, with the latest receipts from the Goldman note that John referenced, is that a week after the tax bills were done, the checks go alongside that paperwork, and they're finally being processed. It does look like there is a lot more receipts than they were previously expecting, which is why they have pushed back that X date to July, and when others were saying potentially June.
And John, I brought this up with you before, Lisa. I think this is just so important. In England, there's a transparency about this. In America, there's this tax, that tax, the other tax, and that's where the Republican angst comes from. The summation of all the taxes we pay it's like the 70s. It's like the time of Rockefeller.
Well, and that's a real question as we go forward. What did Kevin McCarthy have to give up, Anne-Marie, in order to get this deal?
Well, he had to give up some more breaks in terms of, or get the breaks back in the bill for biofuels and investments, and that's really for the Midwestern Republicans. He also had to accelerate the work requirements to next year instead of 2025 for those in Medicaid. The thing that he really did give up with his conference is that he let on that they can make changes, because he came out and said, this is what the bill is, there will be 0 changes. And just a few hours later, this was in a committee that went well into the morning hours. It wrapped about 2 o'clock in the morning. There were changes that were made. So what Democrats are saying is that what McCarthy has done was openly say, basically show a little bit of his hand, and then had to go back on his word, because he said he was not going to change this bill, and then he did just that. But at the end of the day, he was victorious yesterday, and really what the White House, I think, was trying to do was just say, we're only doing a clean debt limit, and really thought the Republicans were not going to be able to coalesce around one bill, given the fact that you are dealing with individuals that have really very different ideologies about what this budget, Republican budget, should look like. But he was able to do that in one vote. So really now the ball is in the White House's court, because obviously this is dead on arrival in the Senate. That's what Schumer said.
Which is a reason why I'm curious about whether this actually means that Kevin McCarthy has wrangled people together, and whether this actually will lead to a more clean resolution to this. Bob Dole of Crossmark on earlier saying that he actually thinks that this will accelerate some sort of resolution and makes it more likely. Do you agree? Do the people who you speak with in Washington think it was that kind of step?
Well, I think what this does do is means that there needs to be another conversation. And it obviously points to the fact that there needs to be a negotiation, and the X date in July, that is pretty soon. Remember, on Friday, Speaker McCarthy is going to Israel, there's a recess, and then they come back. So it's not a ton of time, given the fact that we're in spring, we're getting into the summer. But where this could become very, very tricky, if the Biden administration decides to negotiate with the speaker and it gets very close to that brink, is he able to make sure those ultra-conservatives do sign up in the end? Because right now, this is not a bill that President Biden, or anything on this bill, they're going to be able to get through. The statement from the White House was, House Republicans have passed a bill that cuts veterans' health care, education, Meals on Wheels, public safety. They say, no way, this bill has no chance of becoming law. So even if there is a negotiation, McCarthy has to give up a lot that was in that bill. And at that point, does he lose the ultra-right? And potentially, do they call a no-confidence vote on him? So I think that's where things will get very dramatic.
AMH. On the latest. Anne-Marie, thank you. Looking forward to the coverage a little bit later on Balance of Power at 5 p.m. Eastern Time. Senator Tina Smith, a Democrat, coming up a little bit later from Minnesota. TK.
John, on behalf of the people of the United States of America, I'm embarrassed that we had to walk through that for you. It's not like this in England, is it?
No.
What she just
Well,
walked
there's no
through,
debt limit.
that was brilliant what Anne-Marie just did. I mean, the explanations. But from my childhood, this is just childish. There's no
It's
other
getting
way to
more
put
and
it.
more childish.
It's
Tom.
ridiculous.
I have to make this point, repeatedly. These aren't partisan talking points. This is childish on both sides of the aisle. The way this happens every single time. Every single Congress, regardless of who is in charge of it, comes to an agreement about what to spend. And then we have this whole spat around the debt limit on spending that's already agreed. I mean, I just don't understand it. I don't get it. And then ultimately, this is all things that should be solved at the ballot box, at the polls. Go win an election and then cut spending if you want to. Isn't that how this should work?
The problem is that having a nuanced debate about where we spend our money doesn't sell in terms of political points. It typically isn't exactly the ads that you're going to be putting out there. The nitty-gritty, technocratic kinds of aspects that make a government run well isn't necessarily what people want to get into. So there are these talking points that end up being more social on both sides that ends up being really difficult to really get some sort of consensus and then honest look at how to make things function well.
I mean, I just sent Anne-Marie a note on the back message system.
What did you say?
That was just phenomenal, what she explained. I mean, it's really, really clear about a zaniness, a summer of juvenilia to get to, I think, Labor Day. You tell me, Lisa, when do we actually get a decision on this?
I mean, that's what Anne-Marie was saying, that we now have been, and you were talking the Goldman Sachs note saying July is sort of the D-Day now. Does that get pushed out? How long do they have emergency spending? What does it start getting priced into markets? And is that really what we end up with? I mean, you were talking about this earlier. I was looking at 1 month T-bills and 3 month T-bills. 3 month T-bills reaching the highest level since 2007 yesterday. Why? Not because of Fed rate hikes. It was because of this.
Just one anecdote here, folks. I went to a meeting with the head of the IRS, I'll say 8 years ago, 10 years ago, with Bloomberg. No, with Bloomberg.
Okay.
And he basically said, as a Republican, we want to diminish, and not shut down, but diminish the tax agency of the United States of America. He said that was their theme, that was their philosophy.
They've been promising to simplify it for a long, long time.
Not simplify,
there's nothing
diminish it.
Simple about it. Nothing simple about it.
Bizarre.
The equity market positive 0.5% from New York. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Live from New York City, here's the shape of the price action for you on the S&P 500. Equity futures positive by 0.6%. A lift again from big tech, driving the Nasdaq higher by 0.95% on the Nasdaq 100. Facebook and Meta getting it done. Bramo's going to talk about that in just a moment. Let me finish on the bond market for you. 2-year, 10-year, 30-year, 2-year doing nothing. 395 every single day last week, north of 4%. Just a break of that level over the last couple of days, driven by concerns around the economy, some of the regional Fed indicators coming in softer, going into jobless claims a little bit later. GDP is kind of the backward-looking stuff for 1Q. It's about jobless claims from here, Lisa. Does that continue to crack? Does that offer any kind of leading indicator, coincidental indicator about what's happening with the labor market?
That's what people are looking at now. I remember when we used to think that this was too noisy, and now this is potentially better than Q1 GDP, just simply because that real-time kind of sense is that much more important.
Should we get some movers and have a look what's going on?
So what we're looking at is Meta, which has risen as much as 12%, which is what we're seeing right now in pre-market trading. They reported second quarter revenue beating expectations, profits across the board. Just, I can't get over the statistic, 3 billion users on every single day use the products of Meta. This isn't just a story, though, of the biggest tech behemoths. eBay shares are up as well, up 3.3% after reporting better than expected earnings in the second quarter. This idea of people using collectibles and manufactured items as being perhaps more desirable than even other goods. And Vornado Realty Trust, the other side of this trade, down 13% right now in pre-market trading. The owner of offices delayed its dividend. It also authorized a bunch of buybacks, but really this is a story of how bifurcated this market is. On one hand, tech giants consolidating power. On the other, real estate really struggling at a time when, especially in the office space, there is an existential question about how much will actually come.
You're really reading on this. What's your observation of where we are the end of April with commercial real estate?
The problem is it's a long sort of developing process because a lot of these leases have long expiration dates. That said, it seems like the property values have gone down significantly. John, this is a point of concern, especially given the concentration of these assets on big banks and small banks' balance sheets.
Lisa, as you often do, I think you framed it perfectly. Where do we take the cyclical signal from the earnings this morning? Text telling you something. Talked about this with Michael Nathanson of MoffettNathanson. Can you take a cyclical signal away from what you saw with Meta, with ad spend rebounding, or do you look elsewhere for that?
He said no, because it really is a story about the company. If you look elsewhere, you're getting much less positive signals, whether it's UPS and the packages coming down, the volumes. If you take a look at some of the disappointments in other areas, it is very specific with consolidation of power in the giants that have pricing abilities. And that, I think, is giving a real muddied signal.
But then do those companies adapt? The people that are not tech, maybe they had good earnings and the guidance is not so good. What do they do in the next 10 days? What's the meetings they hold now to get to forget about 4th of July to get to June? I just think they adapt.
We've got to work out what happens with the financial system still.
I agree, strongly agree.
We've really fired the starting gun on a process that I don't think we've really got our hands around still just yet. You can go week to week and see signs of stability in the things that you're going to be looking at later. Lisa, you mentioned the Fed data later in the balance sheet. We'll all be focused on that this afternoon. But from here, I still think the consensus view is from here, you get tighter financial conditions, tighter lending standards, which are going to hit very specific parts of the economy much harder than others, and real estate is a feature of that conversation.
You can feel this tug of war. You can feel it in markets. There is this sort of question around how long tech can continue to boost everything else, and how long we can see this sort of drip, drip, drip in the regional banking sector as an overhang that drags everybody down the second there's any new headline on it. But that gives you a sense of just how tense the moment is.
We'll go through the major weightings on the S&P. Huge gains in Meta year to date. Big gains in Microsoft, in Amazon year to date. Apple year to date, decent. And here we are, still in this range of 38 to 4,200 on the S&P 500.
yeah.
Struggling to break out of it, even with those big names doing what they're doing. If you strip them out, as you did earlier, Tom.
It's not all it's not all
flying.
It's not all boats rising. I mean, it's cool. And what that gets to me is our addiction, my addiction to index funds. And the idea of, is it an index fund, or are we all going to have to go individual stock and own NVIDIA, Facebook, and Alphabet? We can do all the names that, I can have a traditional name portfolio.
Yeah.
That would be good. We could work on
Well, I look forward to that.
Let us move forward here. Deborah Cunningham with us, our Global Liquidity Markets CIO, Federated Investors, joining us this morning. Deborah, I want to go to your wheelhouse, which is short paper. We got a $23 trillion annual growth, like the ship going through the water. We have 5.1 trillion in money market funds on the last report. Educate our audience on radio and TV right now about what 5 trillion in money market funds means.
Well, Tom, I'd say probably 2/3 of that, at least, maybe upwards of 70%, are in government securities. So they're invested in repurchase agreements backed by government securities. They're invested in Treasury securities, Treasury bills mostly, although Treasury floaters are a big component as well. Government agencies, the home loan banks, make up a big part of those government money funds. The other 1/3 or so is in non-government securities. So you're talking about prime for the most part, which would be bank CDs. So the banking system, plays a huge part in the credit and health of that system into money market funds. Commercial paper from both financial as well as non-financial firms. And then a much smaller component in the municipal sector, which is, basically state and local government finance.
Federated has a heritage here that goes back. I'll cut to the delicate question. Do we have a risk of breaking the buck? Is there instability within the money market space where we need to worry about moving under 1.00?
That is really not a concern at this point at all, Tom. Generally speaking, when there are interest rates that are stable, which is, close to where we are right now, we do think the Fed will go at least one more time, but, we're not seeing 100, 200 basis point increases in our future at this point. And then at some point, probably not in 2023, but early 2024, going down the other side, generally speaking, that pushes the $1 NAV up, not down. So, but not to a point where it changes off that 2-digit 1.00. The other situation that could happen is with regard to credit deterioration. And again, going back to the banking sector, such a large sector within the money market space, that is also something that, despite, issues with Silicon Valley Bank, despite some of the news articles lately, First Republic, the largest exposures in the money funds are quite healthy, have really stellar balance sheets to deal with even things like commercial real estate issues at this point. So, ultimately, the system is very, very healthy at this point. If you look at the largest sector, again, though, treasuries, government agencies, the debt ceiling, it's out there. It's not going to cause any kind of 1.00 deviation, but it's an issue to contend with, and we have to kind of deal with it in the markets each day.
You're the perfect person to speak with at this moment, because on the credit side, perhaps there still is resilience, there still is strength, there still is a credit worthiness underpinning all of these assets and a stability in the banking sector. But on the deposit side, which you also have a view into, deposits keep leaving banks for some of these higher yielding short-term instruments. Do we have a sense of how much that's ongoing, of how much the $1 billion of deposits that have flown out of banks has only continued to accelerate versus stabilization that we keep hearing about?
I think it started really back in March. If you go, if you look at the Fed's balance sheet, if you look at banks' balance sheets, deposits basically have been leaving the banking system since March of 2022. Amazing. That coincides exactly with when the Fed started increasing rates. Having said that, I think Silicon Valley Bank and people looking into their deposits a little bit more closely kickstarted it a little bit more. And so the velocity of those deposits changing hands now at this point has speeded up. I don't think it's something that's problematic for the banking system. Quite honestly, they were overfunded for a while, which is why there's such large securities balances on the bank's balance sheets. They weren't making loans with those deposits. They were buying securities in the markets.
But what's the read-through of this? If this does continue to accelerate, what kind of scope could we see? Another billion, another $1 trillion out of the banking system? Or how much could we see this sort of ongoing bleed pressure, some potential sales of those securities, or even potentially the credit worthiness if there is less credit extended?
Well, certainly, I think another $1 trillion out of deposits and into money market funds in the scenario that we're talking about, where a Fed, kind of reaches a terminal rate of 5.25%, 5.5%, and then stays there for, at least 6 months or so. I think that's an easy likelihood, that extra $1 trillion. If you look at the, potential for need in the banking system to sell, maybe there's some of that, but quite honestly, the Fed put at this point from a par perspective for their securities portfolios doesn't make that a real problem for them. And to the extent that facility expires within a year, ultimately it's the Fed's decision. If they think that's problematic, I think they could, extend it for another year after that. So I don't see this as a major issue, and certainly not for the top banks, the large money center banks, the large regionals. Maybe some of the smaller, more concentrated geographic banks have some additional issues with that. But for the largest portions of the banking system, it shouldn't be a major problem.
I think almost as soon as these facilities were unveiled, there was a conversation about them being extended. Deborah Cunningham of Federated Hermes. Deborah, thank you, as always. Yesterday, Bob Michael, JP Morgan Asset Management, on Bloomberg said this. Here's the quote. Historically, from the last Fed rate hike to recession, it's averaged 13 months. He went on to say, we're saying the last rate hike will be in May, and by November, December time, you'll be in recession. Midway to recession, the Fed starts cutting rates. That's how we get to something like September. September's the call for Bob and the team for the first rate cut.
I go to Ed Hyman here with Julian Emanuel writing every day on earnings, and the revenues have come in well, but Ed Hyman sticks with the recession call, and let's recall he gets yields back under 3%. Ed Hyman and Steve Major, two different worlds, but they're linked up together. That's all there is to it.
Bob was saying the same thing, 3%, 2 year.
Lisa, what does that do to the credit space?
Lisa, right the way out.
If we get that dynamic, maybe it says First Republic Bank, what's it do to credit?
Well, at that point, you have to imagine that credit is experiencing a little more stress because of the weakness. The problem with this market is it's the market that called wolf. It's the economy that called wolf. It's basically saying we're going to have recession, we're going to have recession. Everyone's been saying it, and then outperformance, outperformance, outperformance. How many times can people keep saying it? At the same time, it doesn't mean that it's not going to happen.
The tech performance has been phenomenal. I said that Meta was the stock that people love to hate. Tech's kind of been the story that people love to hate this year.
100%. And so has the economic data that's come in stronger than expected.
Resilience. Resilience seems to be a word that keeps coming up. Stability. Haven't seen much stability around certain banking names. We can talk about them in a moment. Your equity market positive 0.5%.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. After making a few adjustments to his debt limit bill, Speaker Kevin McCarthy's plan has passed the House. The vote now puts pressure on President Joe Biden to begin talks with Republicans over the debt limit to avoid a possible payment default this summer. The president has said that it has no chance of becoming a law. Billionaire hedge fund manager Ray Dalio warns that the relationship between the U.S. and China is in a very risky period. In a LinkedIn post, the founder of Bridgewater Associates says the two countries are on the brink of war, and the situation will get worse as the U.S. heads into an election year. Dalio cites disputes over Taiwan and Russia as potential red lines. U.S. prosecutors say that the Air National Guardsman charged with the most damaging intelligence disclosures in a decade also tried to cover his tracks. In a filing, the government accused Jack Teixeira of destroying computer equipment and urging an online associate not to talk to investors. Teixeira appears at a detention hearing today. That operations breakdown that disrupted Southwest airline flights in December is still hurting the carrier. Southwest reported a worse-than-expected loss in the first quarter. Those late-year problems caused the airline to cancel more than 16,000 flights. Meanwhile, CEO Bob Jordan says demand for domestic air travel remains strong. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
So let's go inside the boardroom. Let's suppose you win a proxy fight or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Mark became much more aggressive and ruthless on cost control. And that was a big aha, because people thought he was just not going to cut costs. And he's taken about $11 to $12 billion out of cost base in 6 months. And that's extraordinary, right? So the combination of accelerating revenue and then cost cuts, stock's going to keep going. I think it's a $300 stock. I really do.
A $300 stock is the call from Michael Nathanson of MoffettNathanson. This was an $88 name in early November, and Mike was committed to the name. It rallies another 12% this morning, on top of the already 70% plus rally so far year to date. Just absolutely phenomenal. In the pre-market, Tom, 234.80. Let's call it 235 on Facebook this morning.
There's a reset, and they're going to reset into Amazon this afternoon. Lisa, you covered this in your earnings report. I mean, it's real simple here. Let's go Facebooky to Amazon today, and it's about cutting costs, right? It's about a new serious Amazon.
It's a more difficult story to parse because there is the physicality of moving packages from one place to another and the physicality that was challenged in UPS. Amazon will be potentially the most interesting of the big tech to me because it goes not just to this non-cyclical story, but very much to the fundamental underlying economy.
Well, we'll have to see as well. Right now, and John, I think this is important. We've got to get an update here linking Madison to Wall Street. We can do that with a guy from Madison and Wall. Brian Weezer's with us. And for those that don't know, he's been a huge part of Team Surveillance for years with a real understanding of these broader dynamics that we have in digital advertising, stuff, frankly, I don't understand. It's a new Zuckerberg. Michael Nathanson said this is a serious Zuckerberg. Is it just about the growth is over and it's a single-digit reality for all these digital people?
Yes, and that's the thing that I think the industry is going to have a hard time adjusting to. Like, you can't keep growing by double digits as a sector when you are nearly, 70, 80% of all digital advertising, half of all advertising already between Google and Facebook.
So how do you value them if they're no longer growth equities in the same way?
I mean, I wrote a note about year of efficiency or years of efficiency.
Years? Do you think maybe a decade? Do you think this is the new normal? Too big?
Like most businesses, I think they just have to continuously focus on efficiency.
This is very concerning to me because
That's
if you think about it, well, it's concerning to me from an economic perspective if you think about just how much the tech staff supported entire cities, entire ecosystems. Are those staffs going to get entirely laid off to the point where there really is just a skeletal crew akin to what we see in Twitter?
Not necessarily. I mean, they can grow into their size, so to speak, if they're actually running themselves well, right? I mean, the fact is they are going to grow. It's just double-digit growth is a thing of the past.
So going forward, what are you looking for in terms of how much more that can drive gains? How much more you could see some of the increase in the share price just simply based on years of efficiency?
Well, I think investors are going to have to reconcile themselves to the idea that double-digit growth won't be a thing, at least from advertising, right? There are other businesses. I mean, there's all sorts of applications of ad tech to health tech, for example, right? Personalization of advertising is a precursor to personalization of medicine, as an example. There's all sorts of different places that the concepts in advertising can actually be applied elsewhere.
So bring it over to traditional TV. More than anyone I know, you have said traditional TV is not dead. Do you stand by that now?
I was saying that in 2005, 10, 15.
When did it change? Give me a month and a week. You know.
Yeah, about May of whatever. No, I mean, the reality is, did you see Comcast numbers this morning, right? Dropping another 2 million video subscribers.
Okay, so let's go to Fortress Roberts. They've been a huge success as well. Where is Comcast in 5 years, given single digit? What are they supposed to do, move from one single digit to another single digit?
A perfect example, though, broadband is a great business, right? Infrastructure services is a great business, but the paid ad-supported television business, not so much.
What do you expect in Amazon? This is, to me, probably the most interesting story because it's not just about how much business can they consolidate. This is about the fundamental buying and selling of packages that was completely inflated during the pandemic. Does it deserve the 25% pop it's gotten this year?
One of the things I've learned about Amazon, and it's been documented by, I think, your Brad Stone and others, but it's such a cellular organization. They have ways of reinventing themselves in ways that I don't think are widely appreciated. So I have some confidence that they can actually continue to find ways to grow in ways that we just can't expect. Practically, though, the advertising business is still going to keep doing pretty well, right? There's a lot of growth from that. The other thing to keep in mind, and this is a theme with Facebook as well, Meta, Chinese growth. Growth from China has been a big help for Amazon as it has been for Meta.
John, there's things I just miss. We're talking 20 multiples in these stocks. Facebook's at like a 19 multiple. I had no idea Comcast was trading at a 10, 11 multiple. No idea.
Just to pick up on that point you just made, how has China been a help to Meta?
China is the second biggest market for Facebook and Meta because they have advertisers in China spending money outside of China. Have you heard of Temu?
That's amazing.
Yeah. So they cited this. I've been harping on this one for like 10 years almost. And they finally, for the first time, talked about it on an earnings call yesterday.
So Facebook's not in China, but China wants to advertise on Facebook
I estimate
elsewhere.
about $10 billion of revenue.
Wow.
Yes.
So this raises a question about TikTok. This benefit that potentially Meta could get if the U.S. bans TikTok. Is there also the offset that makes that less relevant because the Chinese advertising goes away and this is a massive part of their business?
You actually do need to pay attention to shipping costs and all those sorts of things and whether or not you can continually ship things cheaply from China to the U.S. Because in a trade war situation, as we almost saw during the Trump era, you could have seen no trade between or limited trade between China and the U.S., and that would have impacted advertising for Facebook. Yeah.
So this is actually mind-blowing to me because we're talking about China banning a lot of these devices, a lot of these social media platforms there. The U.S. has TikTok here that's preeminent, and yet China still has a significant presence in the social media that is American through advertising that connects the two dramatically.
Yes, and Amazon too. So Amazon, about 50% of their marketplace activity comes from Chinese vendors.
Okay, so then how much is that going to actually increase Amazon's takeaway that we get today after the bell in a way that people don't appreciate that this is a very China-sensitive stock?
They don't talk about it.
Why do you think they don't talk about it?
I can't possibly imagine.
Well, you must have a read on that. Go on, why do you think they don't talk about it?
I mean, we can speculate, but it was fascinating, like in Facebook for the last decade. Like, it's been a huge source of growth. and they never once talk about it on an earnings call. It's barely mentioned in the Qs and Ks. You can read what I've just mentioned.
Well, come on, you can speculate. You're in a position to speculate. Give me a couple of reasons why you think it might be.
I mean, political sensitivities about relationships with China are always an issue, right? I mean,
they don't want the spotlight on them.
I think that's probably a
What's
good conjecture.
Okay.
We were talking with Michael Nathanson earlier about the generational shift here as Zuckerberg talks about a serious technology company. Are we going to have serious advertising companies, serious Madison Avenue?
There have always been serious advertising companies. I mean, just think about how the broadcast network used to, well, they all wear suits even now.
Can I rip up the script?
Sure.
How in God's name did the Bud Light thing happen? Where was the command and control? I don't want to talk about the social issues of it, but you're expert at this. Yep. Where was the review control where somebody's 3 levels up going, maybe not?
Well, here's the thing. I don't know, obviously, the politics of the internal decision-making, but it's safe to say that they want to be a more inclusive brand. They say they want to be a more inclusive brand. Now, did they really want to be a more inclusive brand? Or did they just kind of think they wanted to be? And I think there's a gap between that.
Elephant in the room. The kids aren't drinking.
Really well said.
Has been the story for years. Yep. They're shying away from booze. And all these companies have tried it with cider, then hard seltzer. They're all trying to come up with ways to get the kids to drink.
Yep. And there's so much good microbrewery beer out there.
Yeah. Things have changed.
But you're talking to a guy from Britain, the land of... They
by kids, I mean anyone responsible over the age of 21 years old. I want to be very careful about that. But the Bud Light thing is really interesting because typically what we do see, and I don't want to get too involved in the culture wars in this country because I have no interest in getting involved in it, but usually the backlash comes from the progressive left. It doesn't come from the right. And the backlash came from the right this time.
Well,
I think that's interesting.
Think of Nike and Colin Kaepernick, right? And the issue is that at least Nike stuck with what they were projecting they cared about.
Cancel culture is both a left-wing and right-wing issue in a major way, and I found that's pretty interesting.
But the backlash has been growing from the right side as well. You see this with respect to ESG and some of the investments and some of the pushback for some of the investment firms. So
it hasn't been demonstrated at the consumer level in quite a pronounced way like we have seen with Bud Light, and I think that's maybe the example, Brian, that you're getting at that I think is pretty interesting. TK, you're right to bring it up.
No,
sensitive topic.
The bigger issue, though, is that brands like investors need to have conviction about what they're doing, and they need to be consistent. And this is the bigger problem. We saw this with Florida under Chapek, where they went inconsistent. That was a bad thing. Inconsistency will kill you.
Can you come more often? I mean, this is what we want, folks. Experts on this stuff, away from all the hot air bandying around.
Meta. You don't want to talk about Meta. Up 11, 12% of the free market.
It's a serious technology company.
Your equity market up 0.5%. Brian, appreciate it. Thank you. Andrew Slipman of Morgan Stanley coming up.
You've been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around U.S. politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, but that stops forward thinking in terms of planning. And therefore, the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return. And to get a long-term return, putting it into private hands is one way of doing it. But really, the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is U.S. public sector owned that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right? And
Yes.
making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
If the Federal Reserve is still going to be focused on these traditional indicators, then we're not going to get relief from them.
We're seeing every day labor markets become a little bit more vulnerable.
We're all watching the jobless claims figures to see if that's telling us something about where we're going.
I think that all points to a recession. So it's not a foregone conclusion, but I think it's the most credible case.
All those lead indicators pointing to slowdown/mild recession. I don't see how we escape it.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. Many narratives out there, John. In this hour, in 29 minutes, Lisa's looking at claims. I'm looking at GDP. And boy, is there a difference on the state of the American economy.
I'll be looking ahead to Amazon earnings, Tom, after the close, because big tech is getting it done in a big way so far this week. Microsoft, then on to Meta. Let's see if Amazon can. Do you want some good news? Betty talked about First Republic. That's the good news this morning. First Republic just not on the radar in quite the same way. Unchanged in the pre-market, but still some big outstanding questions for that financial institution, Tom. They've got to find a solution to this.
Yeah.
That solution's not obvious.
5.87, I'm looking at the Bloomberg terminal, and the volume pre-market is way less than yesterday. And I just wonder, if you're in this, institutional or retail, what do you do at 9:31? I mean, I honestly don't know. Lisa, I think, is it off the radar? Not for Janet Yellen, it's not.
The second that there's a bad headline about First Republic, or even worse, another regional bank, all of a sudden the mood shifts, and we have seen that continually each day. Right now, the strength is coming from the tech giants. It's coming from outperformances from a very low bar of a number of even consumer-facing companies. But here we are at the precipice of something that people have been calling for a long time, and the banking piece of that is really what people are keying into to determine how to sway their moves.
Quantis, bring up the quote on First Republic. We really avoided it in the last 60 minutes. John, 5.47 moments ago, a 5.42 on First Republic, a volatility and an edging down there. You wonder what the news flow is to get to 9:30.
This month has been amazing. Triple-digit name, March 9th. Triple-digit name, and now it's 550. That's how quickly things have changed.
I'm not going to editorialize my opinion on this, but the answer is I think the stock price speaks volumes. People are ignoring it.
Major way.
There's all this navel-gazing over interest rates, and I'm sorry, as the stock comes down, as the capital comes down, as the equity comes down in the firm, people get a clarity of thought.
So you've got financial stress in the banking system of the last, let's call it 6 weeks. Then you've got the economic data. You pointed out GDP, jobless claims, Lisa, coming up a little bit later. And then the Federal Reserve next week is coming around very quickly. You've got May 3rd for the Federal Reserve. A couple of days after that, you've got payrolls. When they look at the economic data, the totality of the economic data, they're going to hike interest rates 25 basis points.
That's what a lot of people think. I can't imagine that they won't, especially because of one data point. the housing market's starting to show signs of rebounding. The fact that if they let up a bit or you see some sort of decline in interest rates, the fact that people go back out, they take loans out, and they buy homes gives you a sense of how much power there is underneath the economy that's going to really. Well, is this optimistic on the economy, but pessimistic for the long-term market reaction? Because to me, what you have is the sort of question of, if you have that strength, the Fed has to hike and hold things there. This market's not priced for that.
I'm going to let you look at MasterCard. John, I'm going to start the data check by looking at American oil in the vicinity of $69 a barrel, 74.56 on American West Texas Intermediate.
Back to way, Brent yesterday. You saw the move yesterday on Brent crude. In London, a break of 80, right now $78 a barrel. We've taken out the OPEC plus cut gains on crude and back to way, Bramo. That speaks to the kind of economic weakness that people are anticipating,
even if they're not seeing it yet. But to me, this is really key. Maybe OPEC Plus was actually acting based on what they saw with the recovery in China and based on what they saw with global growth.
Lisa, on the MasterCard earnings, we got to get to Andrew Slim here, but I'm sorry, they're talking about resilient consumer spending, and David Rosenberg is saying, great, that was so January, and it's evaporated. My head's spinning.
Well, that's the issue, is that people are not understanding where the consumer goes and how long they can keep spending like this. I keep going back to McDonald's, to Procter & Gamble, to these companies, Kimberly-Clark, that raised prices by 10% or more and still are seeing the same kind of sales. There is a resilience. You're seeing it across the board.
Right now, we're going to bring in a guest. We did the data check. That's it for today. We'll do an extra data check here along the way. John, I want you to bring in Andrew Sliman. This guy has decades and decades of experience, and I'm going to guess he's going to say to your good questions, he's never seen it like this.
Andrew Sliman.
That's where we are.
Joined us now of Morgan Stanley Investment Management, portfolio manager. I guess we should start there then, Andrew. Have you ever seen it like this before?
Yeah, I mean, Tom said it right. My head is spinning. It's a tough environment, but it's all tough, right? The markets are never clear. The light never shines. It's green light, all clear to invest. So it is it's definitely confusing. I think Lisa said it best, which is the consumer stays remarkably resilient, but look, financial conditions are tightening, and that's going to affect many businesses, and that's the push-pull, is which do you lean towards, the consumer or tightening financial conditions? That determines your really outlook for the economy. You had a number of lead-ins, people talking about a slowdown in the economy, except the S&P sits at 4,100. That's incredible to me, what's transpired since beginning of March.
You'd been bullish, though. So are you getting more bearish now?
Well, I've been bullish since the beginning of the year, only because we came off a bad last year. Pessimism, I wrote a piece, pessimism is rampant. And I think the market predicted a down earnings year this year. But, the market's had a good first part of the year. We're moving into the summer. I could see a stall out, but there's no question in my mind, the earnings collapsing scenario that's going to retest the low, that scenario is running out of time, because markets price in a recovery of earnings, which should happen next year, and they will trade to a pretty high multiple on that recovery and then let the E work into that. That's historically what's happened. So I would be surprised if we get another leg up in the second half of the year. I just think, it's been a pretty good move, and we just don't know this, what's going on in the next leg of this bank crisis.
Andrew Sliman, you were at Pennsylvania studying with Larry Summers' father in economics a few years ago, and I'm sure you went through the Nifty 50 and all that. If we got a Nifty 7 or a Nifty 20 right now, do you run a portfolio less diversified?
Scares the bejesus out of me, Tom. I mean, this is the stocks, asset prices are tricky. There's an area of the market that's getting extreme relative to the rest of the market, but it looks over the last couple of days and days included, it's going to get more extreme. I know over time, very, very big companies have a harder and harder time growing. Companies don't stay top 5 in the S&P forever because it gets tougher to grow. Governments begin to cause problems in getting approvals on acquisitions. Hello. You know, those are all the seeds that bring down these top companies, but that's not happening yet. So it's tricky. You need to own some exposure, but I think you got to look under the surface because the rest of the market has been left behind and they're pretty cheap.
So Charles Cantor was in the other day with Neuberger Berman, big love of big tech. And so Apple, are you predicting, Andrew, that with the Apple somewhat exponential growth trends on the income statement, that the government will step in, say, in a Euro-esque way against big tech?
You're already starting to see it. You know, not anyway. You're already starting to see it where they're questioning the dominance of these companies. But that doesn't mean these stocks can't do spectacularly well for the next quarter. This is a longer-term issue. I just know that when you have such a weighting of these large companies, and with the government starting to turn against them, that's a bad combination. But it doesn't necessarily mean they'll be brought down. And I'm always mindful of, you know, let's look back. General Electric, AT&T, IBM, Exxon, Bethlehem Steel, you know, they all got to be the big dogs, and, you know, something happened. And, you know, I remember my dad saying to me a long time ago, why would I ever sell General Electric?
Which is a similar kind of statement today for the tech. Andrew, I'm curious, you mentioned the C word, crisis, in the banking sector. When does that become the driving factor once again in markets that seem to have one eye on it, but not all that closely all the time?
Yeah, I mean, that's fascinating. So, you know, you had this crisis early March. The market dropped to, you know, kind of 3,800, 3,850. And then, lo and behold, the economic data ex the banking crisis wasn't so bad. The market runs to 4,100, and now we're having a second round. It's causing anxiety. But the flip side is it's coming during earnings season, and earnings aren't quite as bad as you point out, Lisa. Even not only mega cap, but some of the consumer stocks where expectations were pretty brought down, they're surprising. So I just think we're in this range. I don't think we're going to break out of it. I don't see a big retest of the low because, you know, everywhere I go, people ask me all the time, when's the retest coming? I got cash on the sidelines. I want to put to work. I want to put to work because I raised it last year. So I just think we'll continue to knock around this range, and now we're back to the crisis focus. So could we head down to, you know, kind of 3,900 again? I think it's very possible. I just don't see a breakout until later this year. I think the market will end the year higher than 4,200, and we'll look back and say, boy, oh boy, yet another example of a year post a bad year when expectations were so thoroughly washed out.
Do you remember the start of the year? Wasn't it first half dip and second half rip? Do you remember the consensus?
It seems like
for 2023.
Yeah. Boy, oh boy, was that! And I questioned that. I remember we were on it.
No one even talks about that anymore. Do you remember that? It was like guest after guest.
Yeah.
Apart from Andrew, of course.
And then
others.
And then it became the rip and then dip, and now it's the rip and the rip. That's a little light and a little lighter rip, and then, you know, eventually.
Been some stealthy rallies out there, you know. And Andrew, thanks for being with us, by the way. Andrew Sliman of Morgan Stanley. Thank you, buddy. If you look at, say, Amazon, hardly anyone's talking about it, up 20%.
They're not talking about. That's a key thing.
Not part of it.
And I wonder how many people are on board. Is this a fear of missing out summer we may have?
Andrew was laughing about GE. 5th best performing stock on the S&P.
It's a new GE. That's a different GE, John, than he was talking about with his
He's
father.
talking about a very different company back in the day, I know. But at 47% year today.
Great American tradition. Parents would turn to their kids and say, can you spell Schenectady? That's where GE was, Schenectady. No one could spell it.
Can you spell it?
No, I could never spell it. I flunked every time.
I remember when I first started doing the program with you, and everyone was like, GE. I was like, what is the obsession with this company?
Exactly. No,
GE.
Andrew nailed it.
It's like Dow points and GE. Nothing else matters. The equity market positive 0.6%. So we have that now. We'll have that argument another time. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Bloomberg's learned that Germany is in talks to limit the export of chemicals to China that are used to manufacture semiconductors. Berlin wants to reduce its economic exposure to Beijing. Chancellor Olaf Scholz is trying to balance Germany's interest in China with national security and human rights concerns. Traders at Barclays did better than expected in the first quarter with a surprise increase in fixed income revenue. And that helped offset a drop in deal-making fees at the British bank. In an interview with Bloomberg, Barclays CEO was asked whether the UK was liable to the sort of chaos some U.S. banks just went through.
The UK has been more insulated from that deposit flight across banks than certainly the US has been between the regionals and the big money center banks. Having said that, our deposit franchise grew by about £10 billion during the quarter. And a lot of that was actually people, corporates, putting deposits with us.
While Barclays says costs in the UK rose 9% due to inflation. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
On the David Rubenstein Show, peer-to-peer conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
From our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Markets countdown in Europe from the financial centers of the world. Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. Earnings season is here.
We haven't had a shocker yet.
They are minting money.
Markets are still volatile.
I think it's going to be choppy.
Bloomberg breaks the numbers first.
First quarter results impressive.
The revenue beat is amazing.
With exclusive expert analysis.
This is really important to watch.
Buy on the fear, sell on the news.
Where is the upside in this market?
Do we get answers to that today?
The bottom line speaks for itself, and that's what moves markets.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Historically, from the last Fed rate hike to recession, it's averaged 13 months. We're saying that the last rate hike will be in May. By November, December, you'll be in recession. Midway to recession, the Fed starts cutting rates. That's how we get to something like September.
Bob Michael at JP Morgan Asset Management, just brilliant yesterday. The CIO talking about the potential of recession, rate cuts in September, and why he thinks every single maturity from the 2-year out to the 30-year will yield just 3% and maybe even lower over the next several months. Looking at your market right now, going into economic data, 13 minutes away. Your equity market just about positive on the S&P 500, positive by 0.6%. Your yield unchanged on a 10-year, 344.85. Tom, 13 minutes away from GDP and jobless claims.
Are we ready for the capital gain that Steve Major of West Ham or Bob Michael of Liverpool that they're looking for? Are we ready? Lisa, price, if we get Michael's call, the price up on the Bloomberg Total Return Aggregate Index is unreal. I mean, it's stunning.
I'm smiling because you're identifying strategists and investors based on which football club
I
they
do,
support.
I'm learning.
And I got a message just moments ago. I'll share this with the audience, Tom. Would love to hear TK's thoughts on yesterday's Gunners game. logging into Twitter for the first time in 5 years to ask. Andrew, thank you for that. We appreciate the question. So this individual, Tom, would like to know what you thought of the game yesterday, Arsenal versus Man City.
My amateur take is there's no equivalent to Man City in American sport, even with a stacked Major League Baseball. I look at them, and it's not like 4 or 5 guys that you all know that are stars, but I look at them as 11 or 15 people that seem to be dramatically better than the second, third, fourth, fifth team, including the Tots without Harry Kane.
The Tots. The question I think people would ask, Tom, looking at US sports, is let's imagine there was a US franchise that was essentially effectively owned by a sovereign state.
Right.
Without all these spending caps, without those things, and I know they've made a great effort in European football to introduce some of that stuff, how would some of these other teams compete with them? And that's the challenge of, say, like a Leeds, a Brentford going up against Manchester City.
What I love that you guys do that we don't do is this relegation thing. I think that's really cool. That would really help baseball as well. Your sports report here. We're doing this.
That was it.
10 minutes, 11 minutes before really important economic data. Michael McKee has landed. We'll get to him in a moment. Right now, to link this in to the litmus paper of the global system, which is dollar dynamics, G10 FX strategist, CIBC, Mr. Jeremy Stretch joins us this morning. Jeremy, Mike McKee is big on vectors. He's big on trends. And I guess the vector is GDP down. What does the dollar do, or what does the dollar as a market force indicate with a GDP vector south?
Well, I guess the key question, of course, Tom, is how far south we're going to go with this GDP print. And I think it was very notable that that Atlanta Fed GDP now estimate was revised down quite substantially yesterday, suggestive of the fact that the risks are to the downside of that sort of near 2% annualized rate that is discounted for the market. So as long as we see a number of perhaps 1.5 and higher, somewhere between 1.5 and 2%, we're looking for 1.8 at CIBC, then the dollar probably drifts slightly lower. But I think if you see 1.5 or lower, then I think you do get further weakness and further pressure on the dollar. Because despite that durable goods beat yesterday, we have seen weakness in terms of the US Economic Surprise Index. And I suspect that if we do see disappointing data, as well as the assumption that Q2 is probably going to be negative, then that's going to just weigh further on that sort of invective for where the Fed goes and whether the Fed is realistically going to continue through with that 25 basis point hike that we're expecting next week.
So can you make a foreign exchange bet? I mean, you know, we sit around here and parse this move, that move, but it's about making a successful big figure speculation. Where would CIBC do that now?
Well, I think in the context of the dollar, it is very much the case that we've been looking for a cheaper dollar for a while, and we continue to price into that. I think in the context of the narrative, we saw a new year-to-date high in the euro yesterday, but we've come back from that. But I think if we do see that GDP miss proving to be relatively substantial today, then I think we can see the potential for a euro rally, which could easily see us having another crack up through those sort of 110.95 highs and potentially into the low 111. So I think there is scope for the euro to be a potential beneficiary. And I think the other big context to watch out for in the course of the next 24 hours is the material move in potentially in dollar yen. Not that we're expecting the BOJ to adjust policy tomorrow, but I think any subtle nuances, even in the language, could well see a fairly substantive move to the downside as far as dollar yen is concerned.
Jeremy, wonderful to catch up with you, sir. I've just got to bring some news to our audience. And Mike McKee, I'm going to want your response to this story. This story out just 15 minutes ago, or in the last 15 minutes. So allow me to share it with you, what we've published right now. Federal Reserve Chairman Jerome Powell held a call with a pair of Russian pranksters posing as the Ukrainian President, Volodymyr Zelensky, according to a video shown on Russian state television, apparently thinking that he was speaking to the Ukrainian leader. The video shows Powell answering questions on topics ranging from the outlook for inflation to the Russian central bank. There have been several clips lasting about 15 minutes long. Unclear if the footage was altered in any way, shape or form. This line comes from a Fed spokesperson today. Chair Powell participated in a conversation in January with someone who misrepresented himself as the Ukrainian president. They go on to say, it was a friendly conversation and took place in the context of our standing in support of the Ukrainian people in this challenging time. No sensitive or confidential information was discussed. Mike, two things. One, there's the content of the conversation, And we don't know what's been altered, what hasn't been altered. And the Federal Reserve has said, and I repeat, a friendly conversation, no sensitive or confidential information discussed. That's point one. Point two, how on earth did this happen at the Federal Reserve?
Well, it seems that these pranksters in Russia have done this quite often. Christine Lagarde participated in a call with them. Angela Merkel participated in a call with them. So they have some way of getting past the switchboard, I guess. And obviously the Fed is going to be looking at that and trying to make sure that that doesn't happen again.
Hold on a second, because this really does go fundamentally to the security and the vetting that the Fed is putting up. And it comes at a time where there's been a lot of accusation about sloppiness, whether it's the oversight of SVB, whether it's now the idea that you don't know who you're talking to. Is this something that's frequently raised? Am I making too much and lumping too much together here, or is this a real concern?
It's hard to know. This is a kind of a unique situation, and we don't know how they got through. Obviously, this is something that Congress could look into and ask questions, and probably should ask questions, and the Inspector General at the Fed should be asking questions. But I think it's too early to jump to conclusions about exactly how this happened. Given that they've done this with others before, there must be something that they're doing that that gets them past the gate. Much more important is whether Powell disclosed anything. This was back in January, so it's probably irrelevant now, but at the time it could have been. And the Fed says no, we have to trust them on that. They do apparently think that the video was edited.
I guess we've got to say that probably Powell had a certain silence like he does when you ask him a question at the Fed press conference. It's maybe what happened. Seriously, folks, the report makes clear there wasn't too much talked about in this prankster event. I would suggest the growth of America is not a prankster event, and the debate is heated this time around. Explain where Citigroup is, where Boeing can adjust GDP. How is it possible Boeing can move the needle from a downward vector tilt, as you allude to something more constructive? Are they really that big?
As you know, Tom, from your many purchases of Boeing jets, they're really
more
expensive.
Gulfstream, but yeah.
And that's why they have a big impact on business investment. And they did have a good month in the month of March. The question is it enough? The feeling is no. The Atlanta Fed GDP now was revised down significantly yesterday to just over 1% from over 2%. So we'll see in just a few minutes.
Mike McKee, thank you, sir. The economic data coming up in a couple of minutes' time. We'll break that down for you. US GDP and jobless claims. Looking forward to that conversation. Mike McKee on economic data next on Bloomberg TV and radio.
big ideas. We show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
Today, the Bank of Japan holds its first monetary policy meeting under new leadership. Will they put the brakes on the recent stimulus boom, or is it full steam ahead with the BOJ's yield curve control? Bloomberg TV has full coverage of the meeting and analysis of what it means for the market.
Our BOJ team in Tokyo has learned the latest findings of what we can expect.
Policy normalization has to start at some point.
I would like to do my best to reach the target within 5 years.
It all happens today on Bloomberg.
Bloomberg surveillance on the ECO screen. It is simple. There are 6 simple lines of data here now, from initial jobless claims onto that first look at the America's first quarter GDP, the price index, real GDP, all those different numbers that will come out. And here to help us on the parlor game of the American economy, Michael McKee. Michael, coming out right now, 2 important trends here, isn't it?
Yes, and we're looking at jobless claims first out of the gate here, 230,000. That's a drop from 245 the week before as initially reported. We'll see what the revision was, but that puts paid to the story that all of a sudden we're seeing all these layoffs show up in initial jobless claims. So it's kind of leaves the Fed where it was, with the idea that we have a fairly strong labor market still. We don't know where we're going, but at this moment we see strong labor market. GDP comes in, well, let's call it worse than expected, but maybe better than the whisper number, 1.1%. Remember yesterday, Atlanta Fed severely marked down their GDP Now number, which had a lot of people talking about the possibility of a below 1% growth rate. It was 2.6% in the month before, so it's a significant slowdown. Personal consumption comes in at 3.7%, very strong, up from 1% the month before, a little bit lower than anticipated, which was 0.4. So we're going to have to break down the rest of the numbers here. I'll let you look at the markets, Tom and Lisa, in response to all this, and I'll see where the news was actually made in this GDP number.
Lisa, I went to the 2-year yield, 4.02%, up 7 basis points as well. Not an odd report, Lisa, but the basic idea here of a bond market moving more off inflation data, I would say, and buoyant labor data.
Absolutely.
A quick generalization.
I would say that the sort of shorter term trend of labor markets hanging in there, not necessarily seeing that increase.
Yeah.
In fact, the revisions pretty much in line last week. So we saw a decline in jobless claims at a time when you still have inflation running hot. What is the incentive right now for the Fed not to hike rates at the next meeting, regardless of what comes in with the banks?
Futures up 21. NASDAQ was up a full 1%, even 1.1%. NASDAQ 100 gives away. We're watching the 10-year and 2-year yields, particularly higher yields. Michael McKee, you're the adult in the room with Dr. Piazza. We'll get to her in a moment. But you're the adult here for Bloomberg and for Bloomberg surveillance. How important is this number, or do you really wait for the second and the third look of GDP revision?
Oh, you're going to look at this number because it's the number that's out. It's what people have to work with, and it's the number the Fed's going to have going into its May 3rd meeting. So they're going to be looking at the momentum of the economy, which is somewhat down. Now, the interesting thing is consumer spending went up, and we were all talking about the consumer getting exhausted and their bank accounts going down, but consumer spending rose from 1% to 3.6%. 4.7%. It's business spending that sort of dropped off here. Non-residential fixed investment just up 0.7%, and that was up 4% in the fourth quarter. So a significant drop-off in business spending during the month. And we did see, I'm looking to see here where my numbers are for for the inventories and trade, and I haven't got that yet. So come back to me in just a second, and I'll have that for. Oh, well, change in private inventories here. This is change in private inventories. Inventories fall by 2.26%. They were up 1.47% the month before. So obviously stockpiles were drawn down. That doesn't count on GDP. So we are seeing a decline there as well. And then net exports were barely changed, up just 0.1% basically after almost 0.5 the month before. So we didn't get a big contribution from inventories, and we didn't get a big contribution from business. But in terms of the other components, not bad so far. Government up 0.8%.
Well, that's a good feeling to know,
which is a little bit better than last month, but not a significant increase as we have seen in some previous months.
Mike, thank you. 4% on the 2-year yield as well. Lindsay Pieggs is joining us now from Stifel here to distill this and move forward as well. Let me ask you the same question. Good morning.
Good morning.
That I asked Michael McKee. First look at GDP. What will the second and third look like? When do we get them? Like a month out, do we get a second look?
Exactly. We'll get them periodically throughout now going forward for the next several weeks. But I think to your point, this is going to set the tone. So the first look is very important. Yes, we do expect some revisions. There always are. But this sets the tone for what the expectation of the U.S. economy was at the start of the year. And it tells us two things. One, we're losing momentum from what we saw, excuse me, at the end of last year. But two, the economy is still proving resilient despite the fact that the Fed is engaged in a very aggressive upward pathway to tame inflation. And the consumer particularly, forget about all the other details. The consumer is the backbone to the U.S. economy, and the consumer is proving surprisingly resilient.
Well, and we've seen this consistently throughout a lot of the earnings. I mean, I feel like a broken record. The Procter & Gamble price increases of 10%. Consumers have absorbed it, and you can see on the margins, companies actually saying we'd rather raise prices even if we lose volume. How long can that last?
Well, it can last for another month, 2 months, maybe longer, because when we look at the household balance sheet, so we're looking at debt relative to disposable personal income, we're talking about a decade low. So I'm not necessarily advocating for consumers to take on new amounts of credit card debt, but if that's where they need to go, there's quite a bit of additional room to grow that household balance sheet before that becomes a red flag that the consumer needs to cut back.
And the real break in the cycle is when jobless rates start to go up. And that's the reason why people have been waiting for that to happen as sort of a signal. And we aren't really seeing it, at least not in the initial jobless claims yet. What Michael McKee was talking about with business spending coming down, that was the reason for the weakness that came into GDP. How long will that take before that translates into job cuts?
Well, what's interesting is, yes, we saw business investment come down, but we also saw a drawdown in inventories. So if the consumer continues to prove resilient going into the second quarter, we're going to have to see a build back up of inventory growth, which will significantly then contribute to Q2 GDP. So we will have to keep an eye on that. But I think broadly speaking, businesses are anticipating a slowdown in the economy. They're anticipating a recession to come in the second half of the year, and they responded in kind across the first 3 months of the year.
Let me just throw this in here very quickly on inventories. I got the dollar figures here. Inventories grew in the fourth quarter by $136.5 billion. They shrank by $1.6 billion in the first quarter, which is extraordinarily unusual. So businesses basically stopped producing stuff and started selling out of their warehouses.
So, Lindsay, can you weigh in on this? Basically, is this companies more bearish than the consumer is letting on, that they were prepared for an environment that was not as bleak nearly as consumers have proved?
Well, I think it's businesses and economists alike. We were anticipating the consumer to have a significant pullback at the start of the year, but we found that consumers were increasingly willing to turn to credit cards, draw down the last of that pandemic savings, and we also saw an unexpected sputtering of state and local stimulus filter into the economy that provide that additional support to the consumer.
Nominal GDP, I'm going to go back a year here, long ago and far away. 8.5%, big inflation, big real GDP, 7.7%, 6.6%, and now I observe 5.1%. Do you ascribe to a diminished real GDP, a diminished inflation where nominal GDP gets back to, I'm going to say, a 4% normal?
I would suspect that the longer-term run rate of real GDP is sub 2%. I would suspect that it's around, correct, around 1.8% longer term. Once we smooth out some of these cyclical movements, the Fed gets inflation under control, the U.S. economy falls into a downturn or outright recession, and we see recovery, the long-term trajectory of the U.S. economy, I do see as a real rate of under 2%.
The business people listening here, the animal spirit of the country, overlay that, say, 2% real GDP or less on your inflation guess. Is this nominal GDP decline from the pandemic in place where we get a 4% top-line GDP?
Absolutely, 2% real plus 2% inflation. There's our 4% nominal GDP. And I do think that that's a realistic expectation. Without a significant growth in productivity, we're going to struggle to see a real rate of activity above 2% for quite some time.
So this is really the conundrum that markets have been struggling with. And this is sort of, you want it to be good, but not too good because of the Fed comes into play. And right now we're pricing in a 4.2% Fed funds rate come January of next year. Is that consistent with what's required to bring down inflation, given the economy you just portrayed?
No, it's certainly not. That we know from history, historical cycles, that the Fed is going to need to raise rates above that peak level of inflation. And so, as we've long advocated, the Fed is likely to need total policy firming to get up near 6%. Now, I'll concede that if we see tighter credit conditions do some of the Fed's work and pull down inflation faster, that maybe the Fed doesn't need to raise rates quite as high if that total policy firming reflects additional rate hikes as well as an organic change to conditions. But right now, we're not seeing that organic change. And with inflation where it is and a solid level of activity both in the consumer and the broader economy, the Fed needs to continue to move forward, raising rates to tame inflation.
I'm going to get a summary here from Michael McKee. You're on, what, page 14 of the report?
Well, it looks like this was, in large measure, inventories and a cutback in business spending, as Lindsay was talking about.
What did exports, imports do?
Exports and imports were little changed, so we didn't get a major contribution either way. Little bit of an addition to GDP,
What's an
but
inventory?
not much.
Explain to our audience. Lindsay, help here. What is inventory?
Well, when you produce goods, but they're sitting not being purchased yet. So just as you would expect, it's the inventory of production that consumers haven't yet absorbed.
Yeah, it's the value of the goods that have been produced that haven't
that are sitting in warehouses.
Yeah, just the easiest way to think about it is all the cars that are parked outside the automobile manufacturers waiting to be shipped off to dealers.
And Tom, just to sort of confirm the theme of the morning, which is that businesses have been too pessimistic based on where consumers really are. Caterpillar's CEO comes out with this: 2023 will be better than we previously anticipated. Time and again, Tom, they didn't have as much inventory as they needed to meet the demand, so they're drawing down from it, raising questions about how much more they're going to have to produce later.
That's going to be the big issue that'll be debated around the Fed conference table. They don't have the big mahogany table anymore, but they're going to be talking about this because if consumer spending is remaining strong and there's not enough goods, A, that contributes to inflation, and B, that could augur a big increase in production in the next couple of quarters. It's all going to depend on what businesses think is going to happen.
I like this tag team, Lindsay Piegza and Michael McKee. This is really good. We can do this for the second, the third, the fourth, the seventh revision as well. There we are. Really interesting economic report. Neil Dutta looks at it. He says he agrees with McKee. Inventory decline, unsustainable. I have no idea what I just said. Stay with us. Futures up 19. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. After making a few adjustments to his debt limit bill, Speaker Kevin McCarthy's plan has passed the House. The vote now puts pressure on President Joe Biden to begin talks with Republicans over the debt limit to avoid a possible payment default this summer. The president has said that it has no chance of becoming a law. Billionaire hedge fund manager Ray Dalio warns that the relationship between the U.S. and China is in a very risky period. In a LinkedIn post, the founder of Bridgewater Associates says the two countries are on the brink of war, and the situation will get worse as the U.S. heads into an election year. Dalio cites disputes over Taiwan and Russia as potential red lines. U.S. prosecutors say that the Air National Guardsman charged with the most damaging intelligence disclosures in a decade also tried to cover his tracks. In a filing, the government accused Jack Teixeira of destroying computer equipment and urging an online associate not to talk to investigators. Teixeira appears at a detention hearing today. And the founder of the defunct blood testing startup Theranos will stay out of prison a little longer. Elizabeth Holmes was set to begin her 11-year term for wire fraud today, but a federal appeals court put her surrender date on hold until it can rule on Holmes' request to remain free while she fights her conviction. Bloomberg's learned that Germany is in talks to limit the export of chemicals to China that are used to manufacture semiconductors. Berlin wants to reduce its economic exposure to Beijing. Chancellor Olaf Scholz is trying to balance Germany's interests in China with national security and human rights concerns. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
From New York City,
from London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
Said, what's the probability of a recession this year in your view? I would handicap it roughly at, let's call it 70% or so. I mean, a soft landing is not out of the question, but just given the fact that things are definitely appear to be slowing out there. The manufacturing sector, I think at best has stalled. Housing is contracting right now. Consumers are still hanging in there at this point.
Some things stick out, as Dr. Bryson did yesterday at Wells Fargo, coming pretty close in the first look on GDP. Wells Fargo with a more cautious tone, maybe what we see out there as well. And I guess, Lisa, definitely codifies May 3rd, but all of a sudden you and I are sitting here looking at FOMC Go, deciding where to go out to the next Fed meetings as well.
The bearishness in this market is coming from concern about bearishness, and that is what we keep seeing. It's not coming from consumers that keep spending. That is the conundrum for the Fed at a time when businesses aren't keeping up with just how much they're buying. That has been the takeaway from the past few earnings seasons, past few earnings report, as well as what we got with GDP brought down simply by business spending, not by anything else.
I think we underestimate the post-pandemic ramifications. I don't know if you know this, Lisa. It's FRC equity fancy code to get the pre-market on First Republic, and I got a 5.79 there. From First Republic out to bigger issues like what's Boeing doing with aircraft. I mean, it's all tied into a post-pandemic dynamic that is completely original.
The fact that deposits grew so much during the pandemic, that deposits grew so much during a period where people couldn't spend, that fostered all of this buying of securities at banks, and it also gave a lot of money for free financing or cheap financing. That's gone, right? How do we right size? How do we understand where there's resilience versus just simply frayed edges as people try to readjust to something that's perhaps a bit more normal?
We're going to keep Michael McKee here. He's going through all the different data. Maybe he can give us another observation here before he gets ready for the 9 o'clock hour. Ira Jersey with us right now with Bloomberg Intelligence to the bond market as well. Ira, as we talked before we came back on air, you're not looking at May 3rd, you're looking at June 14. What does this information say about summer Federal Reserve meetings?
Yeah, I think that the Federal Reserve is probably going to remain cautious. Like, remember, we talk about all the banking angst and what's going on with First Republic and potential credit tightening later in the year. But at the same time, the Federal Reserve is going to be keenly focused on inflation. And you still have some inflationary dynamics here. Obviously, some of the deflators were a bit higher than were expected. But then you go into things like the wage data, and you still see 6+% annualized increases in wages and salaries over the last 3 months. And you say, okay, well, labor still has pricing power. That means the services sector still hasn't rolled over yet in terms of how much businesses are going to have to increase prices. So I think the Fed is still going to be very cautious as to how hard it has to fight against inflation.
So that's what the market's expecting. That's what's priced in. And we could see a peak Fed funds rate of 5.1% priced in come June. And that goes to 4.2% come January of next year. Does this cohere with the resilience that we see? I mean, this is what Lindsay Piegza was saying. No, absolutely not. She still sees the Fed going up to 6%. Can we even know? Where do you sort of stand on this?
Yeah, so it's it's very difficult to have very deep conviction as to exactly where the terminal rate will be. But my view is that the Fed will hike one more time, maybe two, but we're not going to see a 6% handle on any of the Fed funds, any of the Federal Reserve's measures. But I think what they do is they do pre-commit to staying the course and maintaining rates at 5.25%, 5.5% for the rest of the year. And the advantage of that from their standpoint is you wind up pricing out some of those cuts that are currently priced into the market, because the Fed doesn't want to go too far where they cause a much deeper economic slowdown later. So they want to kind of find a sweet spot where they can slow the economy, but at the same time not cause a deep recession and get inflation lower. And the way to do that is to actually pre-commit somehow and say, look, we're only going to cut if the unemployment rate goes up a few percent and inflation is, say, headline inflation on the PCE deflator is below 3%. If they don't want to pre-commit like that, but I think that's what it will take for the market to actually price out some of these cuts that are easing financial conditions when the Fed doesn't want them to be easier.
Mike, do you think that the Fed has ever been more interested in the balance sheets of banks to make policy? I mean, how much has this just basically been, all right, let's take a look at the data that comes out at 4:30 p.m. today, Eastern, and then tomorrow at 4:15 p.m., and we'll determine policy from there?
Well, I don't think they're going to determine their policy completely on the banking system. One of the interesting questions is how unique is First Republic? They have a very overweight loan portfolio, low interest and jumbo mortgage loan portfolio that many other banks don't have. And we saw very good results from the big banks, the SIFIs. So it may not be the biggest deal out there. I think Ira made the point about incomes. That's probably going to be more important to the Fed, because those incomes will make their way into somebody's bank account, whether it's a money market fund or a bank. And incomes were up, Tom, significantly. Okay. Real disposable personal income increased by 8% in the first quarter, compared with 5% in the fourth quarter. They say it's because people had pay increases in the first quarter, but also because taxes were lower.
Okay, but this...
And we've talked about capital gains taxes being lower.
This is critical. We want to get Ira in here before we end the hour here. This is a Neil Dutta moment. Dutta's been pounding the table along with other optimists that, okay, it's more than a static analysis, folks. That's what this is about. Inflation-adjusted disposable income, did you just say it went up?
Yeah.
And yet the
Real
financial
disposable
media is telling me on every single moment that the real wage is going down because of this pernicious inflation. And you just told me inflation-adjusted disposable income.
Well, remember this
moving
is a quarterly average, and it's also an average of everybody's income. And we know that different strata of income, some people are running ahead of inflation, and some are not. So
Right.
the question is, where are the majority of people? Right now, they seem happy. First quarter savings, 4.8% compared to 4% in the fourth quarter.
Just because of time, I want to get Ira back in here because we're going to lose time here. Ira, really simple here. Deborah Cunningham on earlier with Federated notes, $5.13 trillion in money market funds because everybody's making Michael McKee's real disposable income. Are our money market funds safe this morning, Ira?
Yeah, money market funds are safe in particular because so much of their money right now is at the Federal Reserve in the reverse repo facility. So when a lot of the money that you're seeing is not going into T-bills that mature in June, July, and August because people are worried that there might be a delayed payment. So everyone's buying 1 month T-bills and then putting their money at the ORP facility. So the money funds aren't going to break the buck. You're probably not going to have the issues that you had during the financial crisis when you had banks that were defaulting and that helped that made money funds break the buck. But at the same time, they have gotten very short. In fact, I was just looking at some of the data from Crane Money, the money market fund provider, and the average money market fund now is only 17 days to maturity. So if you buy a money fund,
that's great.
You are buying the absolute shortest maturity bonds that you have.
That's a statistic of the morning. Ira Jersey ending strong with a 17-day money market fund. That's a long-term CD. Ira Jersey, Bloomberg Intelligence. Thank you. Michael McKee, thank you as well. McKee reporting through the morning here on the state of the. That's a statistic of the morning. Ira Jersey ending strong with a 17-day money market fund. That's a long-term CD. Ira Jersey, Bloomberg Intelligence. Thank you. Michael McKee, thank you as well. McKee reporting through the morning here on the state of the American economy. Lisa, should we scramble out and get that 17-day maturity?
I mean, seriously, that's where we're at right now, and that's what you're going to get in terms of some pretty positive gains in basically cash. I'm looking here at the 2-year yield. Those gains have stayed 4.03% now, up from what we started the day as low as 3.92% on that 2-year yield. Suddenly, the Fed's more in game because we could see that resilient consumer we keep talking about is going to make it tough for them to really take any kind of pause.
First time I've done this, I believe. Let's get to it after the May 3 meeting. It's a snooze fest, June 14. Unless the two guys from Russia show up to ask questions in the press conference. June 14, July 26. How do we get to September 20th? I have no idea.
I think nobody knows. I think that's the difficulty, is that people don't know which data to look at.
Right.
And, I keep going back. Andrew Hollenhorst, who's been pretty consistent pushing back against some of the market bearishness in terms of how much the Fed's going to have to fight. They think people are just parsing out. They're looking for the negativity. They're not seeing the positive. Today, he looks more right in terms of this data that came out from the U.S. economy.
Yeah, I'm going to mention Neil Dutta again with a great call here on what incomes do and the dynamics of inflation moving with the real economy. Michael McKee mentioning an optimistic statistic there, which gets you to that June meeting. And I'm also going to mention this off of Michael Darda's wonderful work and others. Nominal GDP is just absolutely critical as an analysis. Right now, the Feds, they're all down at the Eccles building watching us going, Tom doesn't know what he's talking about. Futures up 23 to the moon here. The yield 4.04%, the 2-year. Torsten Slok, 2 p.m. This is Bloomberg's surveillance.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting, and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
This is Bloomberg.
Live from New York City this morning. Good morning, good morning. The equity market bulls this morning, at least, with a lot to like. The tech earnings better than expected. Jobless claims come in. Personal consumption is looking pretty decent, and your equity market is positive. From New York, the countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Coming up, growth in America coming in slower than expected. Speaker McCarthy's debt plan passing the House, and Powell, tricked by pranksters posing as Zelensky. We begin with the big issue, the trade everyone loves to hate.
Big tech leaders.
Quite a big relief.
Encouraged by what Meta has reported.
Positive results from both Google and Microsoft.
The bar has been raised.
The fear going in was way stronger.
Rally for mega cap tech can probably go a little bit further.
The market is hearing AI and getting overly excited.
So excited.
Excitement around generative AI. And we know what happens with frothy reactions, and they can be undone at quite short notice. This is a space that's now trading at a 35% premium.
You just can't justify, the valuations. People are going to start looking for growth.
The problem is I don't think rates will come down. We would take some chips off the table here.
We liked what we heard.
We'll be listening more closely for the rest of the early season.
Joining us now on the West Coast, Ed Ludlow. Ed, Meta getting it done.
Yeah, a lot of it is the strong second quarter outlook, right? So they're forecasting revenue of between $29.5 billion and $32 billion. Even at the low end of that range, they are exceeding Wall Street's expectations. As your guest alluded to, generative AI, artificial intelligence, a big focus. Mark Zuckerberg spent 6 minutes of his opening remarks on the call focused on AI and about 30 seconds on the metaverse. But he made a really clear statement, which is there's been a narrative that Meta has abandoned the metaverse, for which it renamed itself in October of 2021. He said that that is a simply false narrative. He sees AI and the work they're doing in the metaverse going hand in hand. more important for investors is they're believing the cost-cutting story, right? They lowered their expenses forecast for the year again down to a top-end forecast of $90 billion. Reality Labs continues to be an issue for them. Sales at the hardware segment for AR/VR, which is also the driver of the metaverse, basically half of what the street was expecting. And Meta is saying that those operational losses from Facebook Reality Labs are going to continue to grow. But the narrative on cost discipline also goes with a narrative around them committing to invest in the infrastructure to power AI. And if you look across Wall Street and sell-side note reaction this morning, Jonathan, that's where they're going, along with kind of pretty good macro picture and some optimism about the rebound in ads and what they've done on the product side to drive user growth, but also eyeball time on the various platforms that they hold.
Ed, thank you. 27 minutes out from the opening bell. That stock is flying. We'll touch base with Ed again around the opening bell. Right now, that stock at 240. Back in early November, 88. Massive turnaround for Facebook, Meta, and Mark Zuckerberg. Joining us now, Crossmark's Victoria Fernandez, Samir Samana of Wells Fargo. Victoria, Meta gets it done. Microsoft gets it done. Is big tech validating some big gains year to date?
You know, it's a great question, Jonathan, and I'm not sure I have a great answer for it because they have had such large gains in this sector, not even the sector as a whole, but these few names, these FANG names, have had such big runs this year. And you would think that most of any kind of upside potential has already been priced in to the stock. That's what we anticipated. I certainly was surprised at Meta's earnings. I did not expect them to have growth in users. I did not expect to see the positive news coming out of ads. And I would expect that a lot of those efficiencies that people heard, that had already been priced in as well. So I'm a little surprised at the gain that we've seen. When we look at some of the other companies, yes, you knew AI was going to be a big story. But again, I feel like they've had such a big gain. We've actually been trimming some of these names, not selling out of them, but trimming them because of the gains they've had so far this year. I just can't see them continuing to be leadership. The breadth line has become so low across the market that I think we're going to start to see some churning in that leadership position, and tech might pull back a little bit as we go through the year.
Samir, going into these earnings, we were talking about the cyclicality in some of these names. Then you look at cloud in Microsoft, doing okay. Ad spend in Facebook, Meta, doing okay. When you look at these numbers, what's the takeaway for you?
Yeah, I mean, look, I would say, we were excited about tech last year, during the fourth quarter when people were kind of selling it for tax loss purposes, because again, we pointed back to a lot of these secular growth stories, which to your point, don't really rely as much on the economic cycle, right? I mean, Internet of Things, 5G, automation, et cetera. I mean, these are all multi-decade trends that should, for the most part, remain intact. The only real question is what multiple you pay for these earnings. And last year, a lot of these were kind of thrown out with the bathwater. Now, I think, probably that same excitement for us anyways is on the energy side. We think we are in a commodity bull super cycle. We think energy trades at, kind of high single-digit multiples with the highest yield in the S&P. So I think you've got to kind of be somewhat price dependent. And from here, I think energy is the better play.
Facebook right now, 239. Samir likes energy. Crude, struggling just a little bit. We can come back to that a little bit later. Yields higher this morning by 7 basis points. Your 2-year back through 4%. Economic data out about 35 minutes ago. Mike McKee can break that down. Morning, Mike.
Good morning, John. I want to start with jobless claims because that's having an impact on the market. 230,000 after 246,000 the week before. It does suggest the labor market remains tight, and that is going to keep the Fed on alert. And the labor market being tight may have contributed to a stronger consumer spend in the first quarter than anticipated by many people. 3.7%, down from the overall estimate, but it is higher than we saw in the first quarter. GDP overall comes in at 1.1%. Now, people are saying that's weaker than expected, but the Atlanta Fed number that came out late yesterday pushed that number down to about 1.1%, and I wonder how many people would have changed their forecasts had they had the time. Business investment really weak, and the change in inventories is what really moved things in terms of the first quarter. Subtracting $1.6 billion from inventories instead of adding, you can see how much was added in the fourth quarter, and exports, little difference. The data basically say consumer spending is strong, and consumers are hanging in there. Do they continue? Businesses don't seem to think so. so. Business spending dropped off significantly. Trade, little change, as I mentioned, but the inventories crash sets the Fed up for a question. If the consumer remains strong, do companies start building up inventories again, and then growth goes up, and that pushes on inflation? Or do consumers fall back to meet what business expectations are? Real final sales, 3.4%. That takes out the inventory aspect of it, and that suggests we do see some strength. Now, here's the chart that I promised earlier on surveillance, John. This is the Atlanta Fed GDP now. Never mind the numbers on the chart, although they are pretty close at 1.3%. But look at the trend. We started the quarter, came into the year on a high note, and ever since then, the economy has been slowing down. Does that suggest that that's what we're going to see going into the second quarter and onward?
Something for the optimists there, something for the pessimists as well. Where does it leave the debate around the Federal Reserve? We caught up with Bob Michael at JP Morgan Asset Management. He made the case for a rate cut as soon as September. Take a listen.
Historically, from the last Fed rate hike to recession, it's averaged 13 months. We're saying that the last rate hike will be in May. By November, December, you'll be in recession. Midway to recession, the Fed starts cutting rates. That's how we get to something like September.
Victoria, that's the rate cut call. Let's go through the argument against that. Unemployment at the moment, 3.5%. Personal consumption, consumer, looking resilient, robust. You go through the earnings, Kimberly-Clark, Procter & Gamble, Pepsi, Coke, take your pick. Double-digit price increases, no pushback. Even Caterpillar out this morning, Cat saying this, 23 will be better than we previously anticipated. MasterCard spending through the roof. What's the argument for a recession and a rate cut based on what you're seeing right now?
So I actually do believe we're going to see a recession later this year. I don't believe with the rate cut call in September, but let's look at our leading economic indicators. I know you've been watching these as well. We're down 7.7% year over year on leading economic indicators. That is a level you don't typically see outside of a recession. You look at money growth. I know people will say, yes, but there was a huge bump in money growth because of all the stimulus that came into the system. That's true, but we're still seeing a decline in money growth. We're seeing a decline in liquidity. We had $1 trillion in liquidity put into the system in March. Over half of that has come out now, and we're going to have more liquidity come out of the market when the debt ceiling debate is over, because the Treasury is no longer going to be pulling out of their Treasury general account. So more liquidity coming out of the market at a time when there's probably more austerity coming than many people think. So you're going to have slowing consumer, even though they're not collapsing. Consumer is probably slowing. You're going to have more austerity, liquidity coming out of the market, tightening lending standards, slowing loan growth. You put all that together along with 475 and probably 500 after next week basis points of rate hikes working its way through the economy, I think you get a recession at the end of this year. But because the consumer continues to be there, it's going to give a little bit of a foundation. And I think it's a very short-term, weak recession that we have, which is why I don't think we're going to see the rate cuts in September, as you mentioned.
Samir, do they sound like good reasons to buy energy names?
Yeah, I mean, look, this Fed got transitory wrong, and so I think for them this time around, I think they've got to stay more hawkish for longer. It's almost transitory on the other side of it. Right now, they've got to view disinflation as transitory. They just cannot get this inflation, issue wrong a second time. So that's probably what keeps them on the sidelines with respect to rate cuts until probably the first part of next year. Now, that being said, when we bring it all back to markets, I mean, keep in mind that the stock market has had almost a 16-month head start on trying to discount a possible recession, right? If nominal GDP in dollars is still kind of heading up, maybe kind of peaking out, the equity market peaked in the first quarter of 2022. So you've been in this process for 16 months. So although you could see a lot of the economic pain in the second half of this year, I do think the equity markets, especially the S&P 500, is a good bit of ways towards discounting that.
Samir, why the energy patch specifically? Why is that something you're constructive on?
So we love the discipline from the producer side, both on the OPEC plus side and on kind of the U.S. shale side. They are time and again kind of opting for producing less at higher prices and, kind of prioritizing cash flows back to investors. And the fact that they traded such cheap multiples and such high dividend yields means you kind of get paid to wait even if there is a recession.
Samir Samana sticking with us alongside Victoria Fernandez. Let's get you some movers going into the opening bout. We're positive 0.6% on the S&P 500. Here's Abby.
Not surprisingly, John, it is all about Meta in that blowout quarter. Shares are absolutely surging. The best day since early February because, of course, this company, this stock, into the quarter up about 80% on the year. So no stranger this year to big moves. The messaging around the AI and the meeting of the metaverse that Ed Ludlow was talking about, plus cost cutting, plus they just beat right across the board, the revenue guide higher. Amazon up in sympathy, plus the strong cloud quarters out of both Microsoft and Google on Tuesday evening. This company, this stock up higher ahead of that. Southwest Airlines, not so much, down 4.4%. They posted a wider loss of 27 cents versus the estimate of 22 cents. The December turmoil simply hitting this company. They're talking about lower bookings in January and February. Bright spot, March maybe looking a little bit better, but maybe folks don't want to get on those planes knowing the technology is outdated.
Abby, thank you. Coming up on this program, First Republic struggling to find a solution.
The FDIC and the Federal Reserve, it's a really tough dilemma for them. They're stuck between a rock and a hard place.
That conversation up next.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
The FDIC and the Federal Reserve, it's a really tough dilemma for them. They're stuck between a rock and a hard place. Either choice is not very favorable. And so it's something that they have to weigh, which is going to have the least negative impact to the banking system and to the economy. It's the depositors, and it's the depositors over the insurance limit is where the focus is, and that's where the debate is at this time.
First Republic stuck in a standoff between Washington and Wall Street, both sides looking to avoid steep losses as the FDIC ramps up the pressure. Bloomberg reporting the agency is considering downgrading the bank, a move that could limit its access to the Fed's lending facilities. Bloomberg's Shonali Basak has more. Hey, Shonali.
John, if you take a look at First Republic shares, it is trading at 7% of its book value. That is after 2 days of brutal sell-offs, after very little answers after its earnings release. Now, the point you made about the standoff between the U.S. government as well as the big big banks here is this inclination for the big banks not to step in more than they already have, which leads to that question about what's the end game? How long can this bank limp along for? And are there other necessary actions that need to be taken? Now, what we have reported about the FDIC and the potential curbing of borrowing limits via a potential downgrade of its status, it would only just make it more expensive and more difficult for First Republic to find more access to capital. And that is the story under the surface here. How hard is it for this bank to find capital via normal means, let alone extraordinary means? You are seeing the shares really get a break here, a little bit of a relief after that brutal sell-off. But again, it did sell off 50% 2 days ago, another 30% yesterday. So really, until there are questions answered here, a lot of nowhere to go.
Shonali, we haven't heard much from the bank itself. The earnings call earlier this week, you and I discussed it, no Q&A, big disappointment for the analyst, and clearly doesn't really involve much confidence when you hear something like that or don't hear what you want to hear on an earnings call. Shonali, I want to understand what the other big banks are saying. The big banks that deposited this cash at this institution, what have we heard from them?
You know, what's interesting is they're saying a lot of the same things that you're saying. They're pretty shocked that on Monday that there were no answers taken on that call and that there were so few answers for the road ahead here. So it's kind of amazing here that you have some of the biggest banking titans in the world sitting there with their heads scratching around this issue when they have billions of stake at the bank themselves.
Shonali, wonderful coverage as always. The stock is lower by 1.4%. In the grand scheme of things, that's meaningless for First Republic. That was a triple-digit name all the way back to early March 9th, I believe. Then a double-digit name, single-digit, struggling to hold on to 562 on First Republic. Victoria Fernandez, Samir Samana back with us. Victoria, how confident are you that a name like that is ring-fenced and that's an issue for them and not an issue for everybody else?
I do think that we're not going to have this element of contagion that a lot of people are concerned about, but that doesn't mean that we won't have little ripples that go through the economy, especially when it comes to lending standards. Look at these big banks. They're not going to step in and help at this point, in my opinion, unless they get some kind of a federal guarantee. And let's admit it, they haven't been treated the best when they have done it in previous years. So I don't think they're going to jump at the opportunity to do this. Does it mean we get widespread contagion? I just don't think so. Some of these banks had put themselves, because of the risk parameters that they had in place and the choices they made, they put themselves in a very precarious situation. Not all banks are in that same situation. Let's look at PacWest that reported this week. They actually saw their deposits increase. So I don't think we can say that there's contagion, but I think we can say there's concern and what that means in regards to loan growth and lending standards going forward.
Where does it leave the Federal Reserve? This from Evercore. Evercore have this to say about next week's Fed meeting. We can't rule out the possibility developments around First Republic could unfold in a manner that would lead the FOMC to skip May while signaling a hike in June. Samir, how do you think about that, what this ultimately means for the Federal Reserve? The Fed still hiked after SVB. If there were problems here, would it stop them from hiking?
I mean, I don't think this issue is broad enough where it's going to get the Fed to skip next week. I mean, I think the Fed goes next week. We even think the Fed, hikes in June. What we would say more broadly is, I mean, look, there's a lot of regulation coming for smaller and mid-sized banks, and they are going to start acting as if that regulation is coming and as if they're going to have to hold higher capital, which will mean tighter lending standards. So I think, one, this is not a time to be kind of, bottom fishing on smaller and mid-sized banks. Two, I think, smaller and mid-sized corporations will have a much tougher time accessing credit. We literally just downgraded small and mid-sized, capital stocks in the U.S. last week, along with large. And then I think third, I think this just makes kind of that recession that we see in the second half much more likely. So, I know a lot of people point to coincident indicators like the consumer and the labor market. But again, keep in mind that it's those leading indicators that continue to weaken.
Samir, you've just described a bunch of reasons for why the Fed shouldn't hike. Never mind June, why they shouldn't hike next week. Why do you think they'll go in May and June despite everything you just said?
I think it has to do with their mandate, right? Their mandate is inflation. And if you look at inflation, it's just not coming down. If anything, operators have figured out a way to produce less supply while holding the line on pricing. So if the Fed's mandate is, what smaller and mid-sized banks are doing, that's one thing. But if their mandate is inflation, I think they've got to try to balance both.
Victoria, do you agree?
I absolutely agree on that. I mean, Look, PCE numbers that came out this morning is a perfect example of that. We saw consumer spending higher. We saw exports higher. Look at the PMIs that we got last week. The pricing components in the PMIs were higher for goods and services, and that's happened for the last 4 reports. So I think the underlying inflation, let's look at those core month-over-month numbers that we're getting. They may not continue to go down that many people anticipate they will. Maybe they plateau or maybe they go higher like they did last month. That is what the Fed is looking at. They've got wages still at about 6.5% according to the Atlanta Fed wage tracker. You've still got a decent strength in the labor market. So I don't think we have this downward trend in core inflation that the Federal Reserve is looking for. So I agree they go 25 basis points in May, and I'm not opposed to looking at a 25 basis points in June, depending on the numbers that come out. I think they're going to become more and more data dependent as time goes on.
Samir, let's put a bow on this. You described a bunch of dreadful issues in this economy, followed it up by saying Fed's going to go in May, Fed's going to go in June. And yet at the same time, people are plucking out arguments about short and shallow recessions from here, there, and everywhere. Where does that come from?
I don't know. I mean, it's the one thing we can't figure out. I mean, it's the most wishful thinking that we've ever heard of. I mean, to have the Fed cutting interest rates, to have inflation be well under control, and then to also have earnings basically come in at 220 and the economy continue to grow. I mean, it's just not going to happen. So, in our opinion, one of two things does happen. You get a moderate recession, which takes care of inflation, allows the Fed to kind of stand pat and they cut next year, which allows the markets to recover into the end of 2024, not the end of 2023. Or the alternative is that things continue to remain resilient. The Fed has to go even further than markets expect to maybe 5.5, possibly 6. And then the resulting policy mistake is one that probably causes us all to have to rethink some of these numbers.
This is exhausting for us all. Samir Samana, thank you. Victoria Fernandez, to you as well. Thank you very much. 7 minutes out from the opening bell, equities up by 0.6%. Tech getting it done. The Nasdaq well supported through the week so far. Up next, your morning calls, and later, Invesco's Rob Waldner staying cautious on credit amid lingering banking stress. That conversation around the opening bell. The opening bell, 7 minutes away.
Ideas, we show the productivity increases that are possible because of artificial intelligence. It's these companies who could be some of the biggest beneficiaries if they harness AI correctly. I think a lot of people are looking for the killer app, like they look like these viral apps that the internet delivered. The killer app for artificial intelligence is productivity gains, and any company does not harness it is probably not going to be one of the big winners out there. And just one other thing on AI. The real winners here are going to be those companies that have proprietary data and have lots of it, have the best domain expertise, best AI expertise, the best pools of high quality data to basically create new businesses.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone. Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
Minutes out from the opening bell, doing nicely here on the S&P, on the Nasdaq, a real lift. That's the price action. Here are some of the morning calls. First up, BMO, downgrading Electronic Arts to market perform, expressing concerns about the company's mobile strategy. Piper Sandler downgrading Vornado Realty to underway, expecting a challenging year ahead after suspending its dividend. And finally, KeyBank, raising its Meta price target to 280, saying aggressive cost cuts are now being accompanied by improving revenue trends. That stock is flying, up close to 15% in early trading. Up next, upbeat tech earnings overcoming banking stress. That conversation up next with Rob Waldner of Invesco. Your opening bout just around the corner.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Live from New York City this morning. Good morning to you all. About 20 seconds away from the opening bell. Equities positive here by 0.6% on the S&P. On the NASDAQ, absolutely flying. Big tech getting it done in a big way this week so far. The NASDAQ 100 positive by 1.2%. From New York City, the opening bell rings. Switch at the board and get to the bond market. Yields look like this on a 10-year. 10-year Treasury yields higher by 4 basis points, 349.20 on a 10-year. Dollar stronger, euro weaker, just about holding on to 110 right now on a single currency. Crude, positive 0.6%, 74.71 on WTI. Let's get straight to this session. 10 seconds in, positive 0.6% on the S&P. On the NASDAQ, positive almost 1 full percentage point. One stock to watch at the open around the tech story, it's Meta. Shares rallying gone better than expected results. Mark Zuckerberg, the CEO, saying this: a stronger financial position will enable us to weather a volatile environment while remaining focused on our longer-term priorities. Ed Ludlow, we've got some growth.
Yeah, we've got some growth. The stock up more than 14%, which would be its best day since early February, and $77 billion of market cap added back to this name that had a really hard 2022, but has been resurgent so far year to date. It all started with that outlook for the fiscal second quarter, revenues of $29.5 to $32 billion. Even at the low end, that came in above street expectations. On the call, Mark Zuckerberg speaks for 6 minutes about AI and then 30 seconds about the metaverse. But actually, probably the star of the show was the CFO, Susan Lee. A lot of emphasis on efficiency. You look at the expenses forecast. Again, it's been lowered from $92 billion for the year to $90 billion for the year, CapEx 30 to 32 billion. They're telling a story of how this is paying off, but they need to invest on an ongoing basis in the infrastructure to support AI. One point that's not really been discussed this morning, Jonathan, is about the ad market. So there's signs of strength, right? They're driving traffic to their platforms. But remember, we're lapping soft comps. What was happening this time a year ago, the war in Ukraine had started, which had a profound impact on the advertising industry. Lapping those soft comps makes the kind of near-term outlook a lot more attractive. But there is evidence that on the user base, from an ad engagement perspective, this is a company that's doing good at its bread and butter and is excited about AI.
What a move, approaching 240. Ed, thank you. Looking forward to the coverage from you and the team a little bit later. Meta, just working the Bloomberg for you, just quickly, now the best performing stock of the year on the S&P 500. Facebook, up close to 100% on the year. It was second to NVIDIA, knocks NVIDIA off the top of the pile. Meta up by close to 98% year to date. This morning, up 13. The South Side weighing in on this in a major way, as you might expect. This is one of the analysts, the team at Piper Sandler, saying this, boosting the price target and saying the following. Meta successfully passed the baton from cost cuts to revenue re-acceleration. This is the really important point. The business is now operating better and executing faster with fewer employees. Following another impressive print, Meta remains our top pick in digital advertising. That's the team at Piper. That's the stock right there, up by close to 14%. Let's stick with the earnings. Want to get to another name. Shares of Southwest under pressure after reporting bigger than expected quarterly losses. An operational breakdown delaying December flights, resulting in a $380 billion hit. Abby on top of the story this morning. Hey, Abby.
Hey, John. Well, yeah, and that 5% loss on the day, that's the worst day since the beginning of March. So investors not liking this, in fact, down for a third day in a row. And it has everything to do with that wider loss that you're talking about, a loss of 27 cents per share versus 22 cents. Earnings were roughly in line, but that December turmoil, if you recall, people stuck in airports, even one bride missing her wedding because of their faulty technology, that cost them $380 million. Now, relative to bookings, it also hit bookings in January and February for the reason that perhaps folks nervous to get on one of their planes. Not surprisingly, John, this means that we do have the shares of Southwest Airlines underperforming other airlines year to date at a loss. The other airlines up a little bit, in particular United doing well. And I just want to throw in a little bit of breaking news related to transportation. Mobileye, the automobile software company, plunging down, had been down more than 30%. At that point, a record low. They cut their revenue outlook, and some are saying blame Tesla.
Abby, thank you. Southwest is down by close to 5%. Let's go to the industrials. This from Caterpillar, topping profit estimates, delivering some upbeat commentary too. The CEO saying this about 2023. 2023 will be better than we previously expected. Katie Greifeld has more. Hey, Katie.
Hey, John. Well, Caterpillar beat on profit and then some. Just to go through the numbers here, adjusted EPS came in at $4.91. Just for some context, the average analyst estimate was for $3.82. So a big beat there. And it was so good, actually, that analysts are worried it won't last, which might explain why shares are currently down about 4% or so. You had Baird in particular warning that Caterpillar's, quote, outstanding margins may not be sustainable. But regardless, the first quarter, at least, of 2023 was super strong. There had been question marks, of course, over construction demand, particularly in North America, which is Caterpillar's biggest segment. You can see, though, that year-over-year sales growth came in at 31.5% in North America, though, with volumes climbing for other regions as well. And that's good news, given that Caterpillar occupies this global bellwether for the economy.
Wall Street is a funny place sometimes. So good that maybe this is as good as it gets. The stock is lower by 3.7%. Katie, thank you. I want to turn to financials. One name has dominated the conversation. It's First Republic, looking to snap a two-day skid that wiped out more than 64% of its market cap. Bloomberg reporting the U.S. regulators are considering measures that would potentially curb the bank's access to the Fed's lending facilities. The stock this morning, Shanali at least, positive for once.
Yeah, absolutely. That's after it had lost $1.9 billion worth of its market value in the 2 days alone, John. This is now a bank worth about $1 billion, trading at about 7% of its book value. So sorely beaten in the last couple of days alone. Now, where do we go from here? If you take a look here, what's interesting is if you think about First Republic selling all or parts of itself, if it were to sell loan books, what would people buy? Remember, this is a bank that is very heavily exposed to residential, commercial real estate. A lot of those residential loans were also interest only. We're hearing a lot of folks in the market are worried about being able to make money off these loans at the end. So then where does the FDIC fall in? If they are selling all or parts of the bank, what kind of assistance would the government be able to provide if we get to that point? Now, remember, the question is, if this were to continue on a downward trajectory, what is the end game? What is the contagion effect here? We have seen a lot of stemming of issues in the banking system, but the point at which you started at here, curbing access to potentially the Fed's borrowing facilities or FDIC's borrowing, you have an issue of capital when it comes to the banking system. Now, do other banks also face similar fallouts as well? I think that's what you are worried about at the end of the day, access to capital being constrained, as well as what is the broader ripple effect should this bank face more pain in the coming days.
Just turning negative as you and I talk. Shanali, thank you. It's just one of those names at the moment. You just keep up on a screen and just keep watching through the session all over the place, just about turning positive again on the day by about 1/3 of 1%. The broader market story, 7 minutes into the session, we're up by 0.7% here on the S&P 500, on the NASDAQ positive by more than 1% for good reason. Big tech so far, massive weightings of these indexes. Big tech so far doing big things. Microsoft, then Meta, Amazon a little bit later, one to watch. I want to talk about credit briefly. The banking fallout, keeping Invesco's Rob Waldner cautious on credit. Current spreads seem to compensate for potential risk, including recession and volatility in the banking sector. We favor higher quality investment-grade corporate credit over high yield and bank loans. Rob, the risks of a global recession, how pronounced do you think those risks are this morning?
Well, John, I think we need to look at what we're actually seeing is that growth is coming out pretty good. We got GDP data today that was not fantastic, but it was pretty solid. Consumption was good. And we are seeing continuing momentum in the economy. So while recession is a risk, it's a risk for us. It's not the key. It's not an expected outcome. It's just a risk.
How does that stack up with what you're expecting in the Treasury market, Rob?
Well, the Treasury market is caught between the Fed and the disinflationary environment that we're in. So, John, I think we need to think about where we actually are, which is an environment with okay growth and disinflation in our view, versus what expectations might be out there for the Fed and what their forecasts are. And the Fed is keeping rates very high at the short end while we have disinflationary forces and slow growth keeping the long end down, and we're keeping this inversion. And the Treasury market's really caught in between those two. So medium term, great value is available now in the Treasury market. Real yields are some that we haven't seen for quite a long time, but for now, we think we'll be a little bit in the range.
Bob Michael at JP Morgan was on this program yesterday, made the case for recession before the end of the year potentially, made the case for a rate cut by September, made the case, Rob, for the 2-year, the whole curve from 2s all the way out to 30s to drop to 3% and maybe threaten to break that level and have a 2 handle on Treasuries, 2s all the way out to 30. Rob, does that resonate with you at all?
So I think what can happen here towards the end of the year, Jonathan, that could get us into that kind of environment is that if inflation continues to come down as we expect and growth stays positive but not exciting, the Fed will get into what we'll start to call maintenance cuts, because as inflation comes down, real rates at the short end will get higher and higher if nominal rates stay unchanged. So as inflation comes down, we might start to see the Fed follow inflation down if they get some comfort that inflation will continue to come down, and that's what we expect.
So, Rob, that would be the call that would lead to a shift in the yield curve eventually. Rick Reed with BlackRock was thinking about some of these issues, and he said something interesting in yesterday's program. When we had a conversation about where to take yield, what pockets of the market, how much duration you want to take, he said we're in one of these really strange situations where if you give up cash yields and go further out along the curve, you give up yield. Now, Rob, that speaks to something you were talking about with the inversion of the yield curve. Rob, can you speak to that? What's the argument to go further out along the curve?
Well, the argument to go further out along the curve is that the Fed will pivot here at some point, and when it does, those overall rates will come down. I think that I would like to add into it a bit of a sort of credit spread conversation, because if you add in the credit spread that you can get in a sort of high quality corporate bond out the yield curve, you can get pretty good returns. So even year to date, investment grade credit is up 4%, I think, in total return terms. So that's beating cash very handily. So if you continue to get that kind of performance going forward, and what you really need there is stability in rates, spreads to stay stable, you can get some very good returns.
Stability in the banking sector would be nice as well. Big conversation this morning, Rob. I'd love your input on. Is there an argument for the Fed to pause as soon as next week?
Well, I think the Fed, we believe the Fed will pause next week. I doubt it's about the banking system will be the decider, though. I think it's becoming increasingly clear that these are idiosyncratic events that, if you're running a levered book, which a bank essentially is, you need to make sure that your financing is very secure. And for First Republic, their financing was not secure. They've seen this big deposit outflow, and their overall cost of funding has increased dramatically. And so even leaving aside the asset side of the balance sheet, you need to make sure that your funding is secure. And if you don't have secure funding, when that funding either increases in cost or it becomes harder to get, then the problems on your asset side of the balance sheet come to the fore. But that is not all banks. So funding is secure in the system in aggregate. Yeah. It's just not secure for a few particular institutions. And I think that's the thing that we're missing. It's about the funding is causing issues in these banks, and the funding is not a problem for the system overall.
Rob, can I ask one final question?
Yeah.
SVB failed. Credit Suisse failed. Signature Bank failed. First Republic's facing some problems. Can I ask you this? How many banks would need to fail before it was no longer idiosyncratic?
Well, I think you'd need to see some sort of brewing trouble in some of the larger, the larger banks, probably before we got to that in the U.S. that were caused by these factors sort of building momentum, and we certainly don't see that.
Rob, it would have to go that far for you before you'd turn around and say, we got a big, broad issue here.
Well, but so Jonathan, but it is about the funding of. So the question I think you asked me is it systemic? And for the system as a whole, funding I think is quite secure. If you continue to get a lot of stress in regional banks, would it cause some issues in certain sectors of the economy, such as real estate, some local small and medium-sized enterprises? But those are certainly headwinds that we could see in the economy resulting from this. But I think we need to differentiate between the sort of systemic issue and, an impact on growth. And that's what I'm trying to do.
Got it. Understood. Rob, thanks for your time, sir. As always, Rob Wagner there on the latest in this market and the banking issues as well, and the Federal Reserve next week. A lot to get through. About 14 minutes into the session, up by 0.6% on the S&P. The Nasdaq doing nicely. Coming up, the debt debate heating up.
The Senate could pass our bill or send us something that they have, and we'll go to conference. Otherwise, we've done our job.
Speaker McCarthy in conversation with AMH down in Washington, D.C. a little bit later on this afternoon. We'll catch up with Anne-Marie next.
Covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
see DHL is sending a consistent message with its investments. The company spent 123 million euros to upgrade its logistics centre at the Cologne Bonn airport, designing it around key strategic goals.
What I love about this building is it actually shows the big mega trends which formed our strategy 2025, which was inaugurated in 2019 when this building opened. So globalization, connecting the world. E-commerce, we have a lot of sortation facilities here for smaller e-commerce shipments. Sustainability, it's a very sustainable building with solar panels on the roof and everything. And digitalization, and well, you can obviously see that it is quite automated.
How did the team pitch this investment to you initially, and how hard was it as a sell for them? How quickly did you turn around and say, yes, this is worth the 123 million euros?
Of course, you always have to make sure that you have the right capacity for the growth in the network. And at that time, they came and said, hey, we will really see a strong growth in e-commerce volumes on top of the regular B2B growth. We need more sorting capacity. We need this building. And of course, there are always debates. Does it really have to cost 123 million euros and so on? But fortunately, they convinced us, because then with COVID and the volume surge, we urgently needed the capacity.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
Now he should sit down and negotiate. We passed this early. We are in April, way ahead of the debt limit. We just passed the bill. It's not our job to modify it. The Senate can pass our bill or send us something that they have, and we'll go to conference. Otherwise, we've done our job.
Speaker McCarthy, his debt limit bill passed in the House, kicking off what is likely to be a long standoff between the two parties as lawmakers call on President Biden to come to the table.
Happy to meet with McCarthy, but not on whether or not the debt limit gets extended. That's not negotiable.
Bloomberg's Anne-Marie joins us now from Washington, D.C. AMH, do you get the sense the president's coming to the table anytime soon?
Well, what's interesting about the president's comments yesterday, you know, this was a speech about really foreign policy. He's standing there next to the South Korean President Yoon, but he didn't mention the budget. He didn't say the Republicans still haven't addressed a budget. What he said was, we need to make sure that default is off the table. So potentially there's a little bit of an inching, Jonathan, towards some sort of meeting of the minds, at least, of that these two individuals can get in a room. Remember, one of Speaker McCarthy's biggest gripes right now at the White House is that they not have had another conversation since February 1st. What he was able to do yesterday was really a political victory. It's the start of this debt debacle, though. We should not think that we're anywhere near this getting over with in Washington. He was able to coalesce moderate Republicans, far-right Republicans around his bill with one vote on the floor. And really what he's saying now is we were able to pass a bill that does raise the debt ceiling. Obviously, there's a lot of fiscal cuts in that the White House does not want to see. It's dead on arrival in the Senate. But really, it's an opening moment for the White House to start to potentially say, okay, we're going to have to negotiate, but the Republicans were able to get a vote on the floor, and it was able to pass.
There were tons of doubts about him getting it done. We were talking about this. Yeah. Never mind asking the president to negotiate. He had to negotiate with his own party. Gets it through. Anne-Marie, you're going to catch up with Speaker McCarthy a little bit later. I think it airs at about 5 p.m. Eastern time on Balance of Power with Joe Matthew. I'm really looking forward to this conversation. What are you looking at getting at with Speaker McCarthy later?
I think one really key point in this debt debate for the speaker, and what's going to make his job much harder, is you saw how hard it was for him to get Republicans to coalesce around this bill. If he is able to negotiate with the president, so many provisions in this bill, Jonathan, are never going to fly with the Democrats. So at some point, if he is going to be able to negotiate with the president, he's going to have a much weaker bill that then he will need to get through the House. And I think that's where it's going to be much harder for him to get the likes of the Freedom Caucus on board. And he has such a slim majority, he can only lose 4 votes. So that is when it's going to become very tricky for him. Yes, he had a political victory yesterday, but now it just gets harder.
AMH, thank you. Down in Washington. Looking forward to the conversation a little bit later. Another story out of D.C. this morning. Take a listen to this. Federal Reserve Chairman Jay Powell held a call with a pair of Russian pranksters posing as the Ukrainian president. This according to video that's been shown on Russian state television. The Federal Reserve put out this statement. Chair Powell participated in a conversation in January with someone who misrepresented himself as the Ukrainian president. Fed spokesperson went on to say it was a friendly conversation and took place in a context of our standing in support of the Ukrainian people in the challenging time. No sensitive or confidential information was discussed. Mike McKee, I want to bring you in on this. Also important to point out that the Fed also said the video appears to have been edited. Can't confirm it is accurate. Mike, your response to this as this story continues to develop?
Well, there are a couple of things. One is, did Powell discuss anything that he shouldn't have discussed with someone who wasn't the head of state? The Fed says no. I guess we take them at their word for now, but I'm sure the Inspector General would like to ask some questions about that. The other is, how did they get through to Jay Powell? Now, apparently this duo in Russia has done the same thing with a number of other people, including ECB President Christine Lagarde and former German Chancellor Angela Merkel. So they have some way of getting past the guard posts and getting to these policymakers. The issue will be how do they do it, and how do you stop it in the future? Does this rise to the level of a real problem for the Fed? I'm not sure it does, but it could if there was something else to it to happen. One thing to keep in mind, too, is this took place in January, so anything Powell was talking about then probably doesn't matter now.
Well, I think that's part of the story, actually, Mike. What have we only just found out? Was the Federal Reserve aware in January that this was a prank, or only became aware overnight that it was a prank?
That we don't know. We don't know when the Fed found out. I mean, this only just aired on Russian TV, so obviously there was some significant delay here. And again, we don't know what Powell actually said. As you mentioned, the tape edited and it's all dubbed in Russian. But it is an interesting situation.
Amazing. What a story. Mike McKee, thank you. A story we'll stay on top of. Just to repeat, the Federal Reserve saying the video appears to have been edited. Can't confirm it is accurate, but acknowledging that Chairman Powell participated in a conversation in January with someone who misrepresented himself as the Ukrainian president, according to a Fed spokesperson. Overnight, just unbelievable. The broader equity market looks like this on the S&P about 23 minutes into the session, positive by 0.8%. On the NASDAQ, up by more than 1%. A lot of big tech earnings. They continue. Apple next week, Amazon after the close. Your trading diary up next.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
Twenty-six minutes into the session, doing nicely. So far, so good. Up by 0.8% on the S&P, on the Nasdaq positive by 1.27%. Meta flying. Let's get into the trading diary. Coming up a little bit later, Amazon, Intel, Snap reporting after the close. PCE, inflation data, UMIDS, consumer sentiment, personal income and spending numbers Friday, plus the Fed publishing its review on Silicon Valley Bank, all leading up to the Fed's latest rate decision next Wednesday, followed by Apple results the following day. From New York, that is it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
Maybe I should go do something else. I can't do anything better than I'm already doing. I've already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
The Bank of Japan holds its first monetary policy meeting under new leadership. Will they put the brakes on the recent stimulus boom, or is it full steam ahead with the BOJ's yield curve control? Bloomberg TV has full coverage of the meeting and analysis of what it means for the market.
Our BOJ team in Tokyo has learned the latest findings of what we can expect.
Policy normalization has to start at some point.
I would like to do my best to reach the target within 5 years.
It all happens today on Bloomberg.
Welcome back to Bloomberg Daybreak Europe.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Businessweek about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in sari-sari stores every day, also on TV, radio, newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number Fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number Fever quickly became number hysteria. Maids were being jailed for stealing their employer's winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their $1 million peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the NBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we had mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145. and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010, after staying for almost 1 year in the hospital. He died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic. They had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack of the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venergold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Venergold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Venergold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and it will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then like, well, let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, or 50 years, most of them we haven't seen coming. So the danger, the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it and I just watch it until it stops going up and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance, is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
This is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people want to unpack that. And so my audience is, a lot of them are younger investors who are looking to hone their skills.
Tech and write-up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us. The algorithm does impact how you feel. You know, you do notice which videos do better.